Hello and welcome to Session 17 of the Basic Tax course. We're going to begin Session 17 with a review of the Session 16 homework answer key. And of course, the Session 16 homework answer key involved preparation of Form 4562 and depreciation schedules for a business activity, actually two separate activities. And those are described in Part A and Part B, with Part A being a Schedule C activity and Part B being a farming activity. So, of course, for the farming activity, you have to apply farming rules for depreciation, and for the business activity, you would apply other business rules, namely the big difference being, of course, that for most businesses, double declining balance is allowed or 200% declining balance, but for farming activities, you can only claim 150% declining balance. We did give you some additional information in the problem, which is important to follow if you want to get the same answers we did. Firstly, you were to assume that all assets from both depreciation schedules are for the same taxpayer who is filing two Forms 4562, and that the startup costs are to be amortized and not expensed, and to claim a full Section 179 deduction for the copier and a $1,000 Section 179 deduction for the racehorse. Also, that the computer, which is listed property and is not used at a regular business establishment. You should assume business income of $510,000. Do not take 50 or 100% bonus depreciation, and assume that the car has 17,000 business miles and total miles of 20,000. When we look at the assets being listed in Part A, we see we do have a car here at a cost of $20,000, placed in service in 2009 with a business use percentage of 85%, and prior depreciation under Section 179 of $2,000 and other prior depreciation totaling $4,596. For the computer, we have a cost of $2,000, and since this computer is a listed property, we have to treat it as such. The copier costs $5,000, but we're going to claim a Section 179 deduction on that one. The desk costs $450. It is 75% business use. Prior Section 179 deduction was $150, and prior depreciation was $27. For startup costs, we have $3,000 of startup costs. Those need to be entered in Part 6 of Form 4562. The file cabinet has a cost of $120, and the racehorse has a cost of $3,000. But remember, on the racehorse, we are claiming $1,000 of Section 179 deduction. We then also have a dairy cow and a chicken coop for the farming activity, both of which are 100% business use and placed in service during the current year. Well, let's go over and take a look at the answer key. Let's first focus on the car, which is, of course, listed property. And when you're dealing with listed property, you do need to apply the listed property rules. But in the case of a car, you also need to deal with the limits on automobiles. And depending on whether a car is in its first, second, third, or fourth year or later of service, the limit on cars does vary. And it also varies according to what year that car was initially placed in service. Now, one of the things you do need to do when you're preparing a depreciation schedule is to figure the prior depreciation claimed on the car. And so we did want to show you the information that we have on that car for purposes of Form 4562. We do need to complete Section B, Part 5. And in that section, we need to enter a description of the car, the date placed in service, the business use percentage, the cost, the depreciable basis of the car. Well, to figure that prior depreciation, we need to go back and figure what depreciation would have been allowed for 2009 and 2010. So for 2009, we look at a cost of $20,000. We multiply that by 85% and get a depreciable basis of $17,000. But remember, we also have to look at the limit on automobiles in 2009. And for 2009, that limit was $2,960. So we multiply that limit by 85% and we get $2,516. And of that $2,516, $2,000 was claimed as a Section 179 deduction, leaving $516 as depreciation claimed in 2009. Then for 2010, the limit on automobiles is $4,800, but we're going to have 85% limit on that deduction again, which means for 2010, we were allowed $4,080 of depreciation on that car. So for 2009, we have prior depreciation of $516, prior Section 179 deduction of $2,000, and 2010 prior depreciation of $4,080. So the prior depreciation we will enter for the car is going to be $4,596. Now for the computer, since the computer's business use is not more than 50%, the Section 179 deduction is not allowed. It is listed property because it is not used at a regular business establishment, and we're going to calculate first-year depreciation using the straight line method and alternative depreciation. The half-year convention still applies, and ultimately we end up with a cost of $2,000 multiplied by 50% gives us a cost for depreciation of $1,000. So ultimately we end up with $1,000 over 5 times 50%, or $100 of depreciation. Then in Part 1 of Form 4562, we need to figure the amount of Section 179 deduction we're going to be claiming, but we also need to enter the total cost of all assets placed in service during the year that could be eligible for the deduction. And for that, we figure we have the file cabinet placed in service, the copier, the racehorse, the dairy cow, the chicken coop, and the computer. The business use percentages of those are all listed, and that gives us a total of $16,120 to enter on Form 4562, line 2. Now, since the total value of all assets placed in service during the year is less than $2 million, we're not going to be limited by the $2 million limit, and so the allowable Section 179 deduction will not be less than $500,000, or the cost of assets that have qualified for the deduction. And of course, we're going to be going with a much lower number on the cost of assets. Now, for the copier, we have the copier is going to be claimed as a Section 179 deduction. That is the asset we're listing in Part 1 of the Form 4562, and we're also going to list the racehorse in that part, but we're only claiming $1,000 of Section 179 deduction on the racehorse. Next, we move on to the desk. Now, the desk was placed in service in 2010. And any depreciation that is being claimed on the desk in 2011 is going to be entered in Part 3 on Section A for line 17. And so the 2010 depreciation claimed on that desk, we have $450 times 75%, leaves us a basis for depreciation of $338 before we claim a Section 179 deduction. But we did claim a Section 179 deduction of $150, and left us with a depreciable basis of $188. We used the 200% declining balance half-year convention, and for the second year, we're going to end up with $46 of depreciation, and in the first year, we have $27 of depreciation. So you can see those match up with the original problem where we have $150 of Section 179 deduction, $27 of prior depreciation, and current depreciation is going to be $46. For the racehorse, we have a cost basis of $3,000. We're going to take a Section 179 deduction of $1,000, leaving a depreciable basis of $2,000. It is listed as 3-year property with double declining or 200% declining balance. So after we apply the half-year convention, the first-year depreciation on the remaining $2,000 cost of that horse is going to be $667. Then on the file cabinet, we have a cost of $120. And we will enter that on the Form 4562 and depreciate it accordingly. Startup costs, as I've already said, are going to be entered in Part 6 of the form. We need to enter the months and year placed in service, and then allocate amortization at a rate of 15 years. But for the first year, we're only going to be allowed the actual months that it was placed in service. And since it was placed in service in June, we'll get the month of June plus all the other months of the year, which is 7 months. So we're going to take 3,000 divided by 15, divided by 12, multiplied by 7, and that gives us $117. So here is the depreciation schedule that we figured for the Schedule C activity. We have the car costing $20,000, a business use percentage of 85%, a prior Section 179 deduction of $2,000, leaving a depreciable basis of $15,000, and double declining balance. The rate for depreciation in the third year is 19.2%, but we're going to be limited by the limits on automobiles. So when a car is placed in service and it's subject to the limits on automobiles, we have the first-year limit, we have the second-year limit, and in the case of this example, we also have the third-year limit. Well, in the third year, the limit on automobiles is $2,850. So we need to take $2,850, multiply that by the business use percentage on the car of 85%, and that gives us $2,423 of maximum allowable current year depreciation. That's where you're going to see our depreciation schedule has $2,423 as the allowable current depreciation on that car. For the computer, we have a cost of $2,000, business use percentage of $50,000, a basis for depreciation is $1,000, 5 years straight line, half-year convention. The rate of 10% is what is allowed, and that gives us $100. For the desk, we have a cost of $450, a business use percentage of 75%. Section 179 deduction is $150, leaving a basis for depreciation of $188. In the second year, we get 24.49% or $46. For the copier, we're claiming a Section 179 deduction, so we have no amount of depreciation that's going to be claimed this year. We're going to have a Section 179 deduction claimed, but this particular depreciation schedule is putting it in the current year column. And again, there's no set rule on how things should look as long as it all makes sense to you. The file cabinet has a cost of $120 and a basis for depreciation of $120. We're claiming 200% declining balance over 7 years. That gives us a current year depreciation deduction on the file cabinet of $17. The racehorse has a cost of $3,000 minus $1,000 of Section 179 deduction, leaves us with a basis of $2,000. We're going to depreciate it 3 years using double declining balance. That leaves total first year depreciation of $1,667, of which $1,000 is Section 179 deduction and the other $667 is depreciation. And finally, the business startup costs are being depreciated straight line over 15 years using amortization rules. $117 is the first year of amortization. Next, we have the dairy cow and the chicken coop. The dairy cow has a cost of $2,000, 100% business use, a depreciable basis of $2,000, a life of 5 years, and 150% declining balance. So we're essentially going to go $2,000 divided by 5 years, multiplied by 150%, and then, of course, we have to apply the half-year convention. And once we've done that, we get current first-year depreciation of $300. We then have the chicken coop at a cost of $5,000. We multiply that by 150% and then multiply it by 50% to get current depreciation of $375. And here is the 4562 for homework part A. Of course, we have a Schedule C as the listed business activity. The assets being Section 179 are the copier and the racehorse. The total cost of the property is shown in column B. The elected 179 expense deduction is in column C. So $5,000 is Section 179 for the copier, $1,000 for the racehorse. The total Section 179 election is $6,000. Then on line 17, we show the amount of depreciation for assets placed in service in an earlier year. There is only one asset that is figured for this line, and that is the desk. So the desk was $27 of first-year depreciation in 2010, and for 2011, the depreciation deduction that we showed you on the depreciation schedule is $46. For the assets that were placed in service in 2011, the first asset listed as 3-year property is the racehorse, and the deduction on that is $667. The second asset listed is the file cabinet at a cost of $120 and a depreciation deduction of $17. We also, of course, have to complete page 2 before we can really finish off page 1. And on page 2, we show the car, the date placed in service, the business use percentage, the cost basis, the depreciable basis for the business, which of course is going to be the cost multiplied by 85%, minus $2,000 for prior Section 179 deduction, and that leaves us with $15,000. That is going to be limited to a maximum deduction of $2,423 because of the limit on automobiles, and of course we're taking $2,850, multiplying that by 85% and entering the total here. Then we have the computer, which is listed property. It is not used more than 50% in a business. We therefore have to enter it on line 27. The cost is $2,000. After we multiply it by the business use percentage, we have a basis for depreciation of $1,000. It's 5 years straight line depreciation with a half-year convention and a $100 deduction. So total depreciation being claimed on page 2 in part 5 is $2,523. That carries over to page 1 and is entered here on line 21. Next, we add up the amounts showing on page 1. We have 6,000 plus 46 plus 667 plus 17 plus the 2523, and that gives us $9,253 of total depreciation. And as I've said in the past, just as an afterthought, in Part 6 we show the amortization deduction, business startup costs, the amortizable amount, the section code under which they apply, which is Section 195, and the amortization deduction. This amortization deduction is not treated as a depreciation deduction and is in fact listed as an other expense on Schedule C. It is not entered as a depreciation expense on Schedule C. Next, we have the homework assignment B, which involves a depreciation schedule for a farming activity. You'll see we've entered Schedule F1. We enter the cost of the cow, which is $2,000 and is 5-year property. We multiply that by the half-year convention. 150% declining balance, there's that $300 deduction. Then we had the chicken coop, which is 10-year property, costing $5,000. So $5,000 over 10 years multiplied by 150%, and then a half-year convention, of course, multiplied by 50% gives us a $375 deduction. You add 300 and 375, and the farming activity gets a $675 depreciation deduction. So that concludes the review of the Session 16 homework answer key. It is now time to push pause on video playback and complete the Session 15-16 quiz, which is a big, long quiz on depreciation. I'm sure you'll find it challenging. Good luck with that. When you're finished with the Session 15-16 quiz, please resume video playback for the Session 17 lecture. And in Session 17, we get onto the sale of assets with Schedule D and Form 4562. So I hope you enjoy the lecture.
And with that, thank you for attending. And again, welcome to Sale of Assets. We are going to move on in our manual after a brief look at the front page here, where it says, here is your reading assignment. And your reading assignment has a few pages from Pub 17, but more to the point, Pub 444, Sales and Other Dispositions of Assets, is the big manual or the big publication that you should be reading if you want to get more of a handle on today's topics. Now, throughout today's class, I may reference other publications as well, but by and large, most of the information in today's class will come from publication 544. And we're going to begin with a brief introduction. The whole point of today's class is going to be to get you to really have a handle on how sales occur and how the way an item is sold, or whether an item is sold as a capital asset that is personally owned or as a business asset, is going to have different reporting requirements. And as a tax preparer, it's our job to understand what the reporting requirements are, how to calculate gains and losses, how to determine if an asset is short-term or long-term, how to determine if an asset is subject to recapture rules on depreciation or whether it only has recovery rules on depreciation. So we're going to be learning lots of terminology today, and getting the terminology clear in your mind would be a good step to actually understanding what you're doing. When you understand the difference between recapture and recovery, you're already understanding quite a bit. So when we get to that, pay close attention. We're going to start here on this line where it says sales and trades. And in order to calculate whether or not you have a taxable sale, you must first determine the nature of the property you are selling and whether you sold it at a gain or a loss. In general, you do not need to report the sale of personal property that you sell at a loss. This is because the IRS does not allow you to deduct personal losses. Hurtful as they might be, just aren't allowed to do it. But of course, if you sell your personal property at a profit, then Uncle Sam does want a piece of that profit. Or if you sold investment property, then you do need to report the sale whether the investment property is sold at a profit or a loss. So here's the first two terms of the day. The first one is sale. A sale is generally a transfer of property for money or a promise to pay money in the form of a mortgage or note. A trade is a transfer of property for other property. If you sell property for money and then immediately use that money to purchase replacement property, you do not have a trade. So a trade only occurs when I trade my horse for your cow. That's a trade. that if I sell my horse, get cash, and go buy your cow, that's not a trade. That's what IRS is saying there. Now we're going to go on to capital gains and losses. Generally, you will have a capital gain or loss if you sell or exchange a capital asset. You may also have a capital gain or loss if you sell a Section 1231 business asset at a gain. So earlier, in an earlier class called Basis of Assets, we talked about the definition of a capital asset. And one of the definitions that IRS has for a capital asset is that a capital asset is typically not a depreciable business asset. Capital asset is anything of personal property that you own, including your house, your pet cat, your furniture. Assets are also cash in the bank, investments, and so forth. But if you're running a business, per se, even though, let's say, a refrigerator in your business that you keep in the lunchroom looks the same as the refrigerator you might have at home, IRS says the one at home is a capital asset and the one in the office is not. They're both assets, but the word capital is what's important, because capital means that when you sell it, it gets capital gain treatment. And therefore, an asset is not considered to be a capital asset if it's used in a business, because if the business then sells that asset, typically it is not the sale that's going to get reported on Schedule D like a capital asset is. It's a sale that gets reported on Form 4797. Now, oddly enough, as we'll see, even though a business might sell an asset that is not deemed to be a capital asset, it may in the end get capital gain treatment anyway. So that makes it even more confusing. Capital assets are capital assets, but even assets that are not capital assets can still get capital gain treatment. So that's some of the information we're going to cover today. Now, when you sell property, you're going to need to define its character, and that is define the character of the gain or loss. And we've already been talking about that a little bit. You're going to need to classify the character as either ordinary or capital gain. Ordinary gains result from the sale of non-capital assets, such as property held mainly for sale to customers, otherwise known as inventory or sometimes stock in trade. Depreciable property used in your trade or business, real property used in your trade or business. Also, something else in here that's going to take a little bit longer to explain. A copyright, a literary, musical, or artistic composition, a letter or memorandum, or similar property such as drafts of speeches, recordings, transcripts, manuscripts, drawings, or photographs that are created by your personal efforts, prepared or produced by you, in other words, you paid someone to make them for you, or received from a person who created the property or for whom the property was prepared under circumstances, for example, by gift, entitling you to the basis of the person who created the property or for whom it was prepared or produced. So essentially what that's saying is if you write a speech, now if I write a speech, I doubt it's worth very much money, but if Hillary Clinton writes a speech, that might be worth something, the original paper, and I think if anyone got their hand on Abraham Lincoln's original speech handwritten out, that's probably worth a lot of money. So those types of documents can have value, but when you are the person who created that document, it's not considered to be a capital asset to you. Now, someone could come along and buy it from you, and for them it would become a capital asset. So the creator of an asset usually is not the one that gets to call it a capital asset. However, there is this special group of people right here. You can elect to treat musical compositions and copyrights in musical works as capital assets when you sell or exchange them if your personal efforts created the property or you acquired the property under circumstances, for example, by gift, entitling you to the basis of the person who created the property or for whom it was prepared or produced. Now, how do you make the election? Well, you make a separate election for each musical composition or copyright in a musical work. And essentially, you make the election by treating it as a capital asset when you report it on your tax return. In other words, you report it on Form 8949, carry the profit, presumably profit, to Schedule D, and then report it that way. How else would you report it? Well, it would actually be perhaps be reported as business income, gross receipts from your work. Because if you are an artist and you create, say, a painting, and you sell that painting, you are selling something you made. You're selling something you manufactured. It would be inventory of a sort. So IRS is saying, not with paintings, but yes with music. If you write a song and then sell it, you don't need to report it as business income. You can make an election to report it as capital gain income. But that is the only rule for why musicians got that special treatment. I don't know. Now, accounts or notes receivable are also not capital assets, and supplies of a type you regularly use or consume in the ordinary course of your trade or business are not capital assets. So let's look at the types of things that are capital assets that would result in a capital gain if you sell them. Capital gains result from the sale of your personal assets or investments from things like stocks or bonds held in your personal account, a house owned and used by you and your family, household furnishings, a car used for pleasure or commuting, coin or stamp collections, gems and jewelry, gold, silver, or any other metal, and also, this is an interesting one, timber grown on your home property or investment property, even if you make casual sales of the timber. Now, this timber sale topic comes up quite a bit here in the Pacific Northwest. We have lots of trees here that people occasionally cut down and sell, and there is a great deal of confusion that comes up when trees get cut down, because is that like farming income? What do I do with that? And the IRS says, unless you're in the business of timber, trees you own on your land are a capital asset. If you cut your trees down and you sell them, you've just sold a capital asset, and it gets reported on Form 8949 and is subject to the capital gain rules. It receives capital gain treatment, not self-employment treatment. Now, I've seen several times over the years where people have incorrectly reported the sale of timber off of their land as farm income and then paid a bunch of self-employment tax on it that they didn't owe. So that's a fairly major issue. The only people who would report timber as business income would be, well, timber companies. All right, holding period is the next term we're going to look at. If you sold or traded investment property, you must determine your holding period for the property. Your holding period determines whether any capital gain or loss was short-term or long-term as follows. Short-term, long-term is really important because if you sell it short-term, you do not get special tax treatment. Short-term capital assets that are held short-term and sold for a profit are taxed as ordinary income. And capital assets that are held long-term and sold at a profit get capital gain treatment at reduced tax rates, very favorable tax rates currently. So getting the holding period correct is crucially important, not just for tax rates, but even just filling out the tax form and getting your entries on the correct lines. Now, to determine how long you held the investment property, you begin counting on the date after you acquired the property, and the day you dispose of the property is a part of your holding period. So short-term investment property is investment property that is held 1 year or less. And long-term investment property is investment property that is held for more than a year. Here's an illustration. You bought an asset on June 18, 2010. You start counting the next day, which is June 19, 2010. If you sold the asset on June 18, 2011, which is exactly a year later, your holding period is 1 year. It is not longer than a year. It is 1 year, and as such, it's considered to be short-term. Therefore, in order to hold it long-term, you have to hold it at least a year and a day, which means in this illustration, if you then sell the asset on June 19, 2011, your holding period would be 1 year and 1 day, which is more than a year and makes it long-term. Securities traded on established markets. If you bought or sold through the stock market, your holding period begins on the day after the trade date that you bought the securities and ends on the trade date that you sold them. You should not confuse the trade date with the settlement date, which is the date by which the stock must be delivered and payment must be made. So in effect, the date you order it is the date that it occurs, not the date that the transaction is finalized. Stock dividends. If you receive taxable dividends in the form of stock, essentially a dividend reinvestment, your holding period begins on the date of the dividend reinvestment. So let's just suppose you own shares in Microsoft, and Microsoft has a dividend that it issues out. Some people choose to receive dividends as checks. They show up in the mail, and they cash them and spend the money, or they cash them and put them in their bank account. Other people choose to reinvest their dividends, so that the dividends are used to buy more shares. And if you have dividends that are being reinvested to buy more shares, the date of purchase on those shares is obviously the date that those dividends were reinvested and paid for them. Non-taxable trades. If you received property in a trade, your holding period for the new property begins on the day after you originally acquired the old property that you traded away. Property received as a gift. Your holding period for property you receive as a gift depends on your basis. If your basis is the giver's adjusted basis, your holding period starts on the same day as the giver's holding period began. If your basis is fair market value, your holding period starts on the day after the date of the gift. Now, we spent some time talking about this concept in our course on basis of assets. I'm not going to do more on that today, but there is quite a bit to kind of cement in your mind understanding those two terms. Inherited property. If you inherited property, your holding period is always long-term. When reporting the sale of inherited property, you need to enter inherit on Form 8949 or Form 4797 as the acquisition date. Do not enter the date that the person died. Do not enter the date that the person who died bought it. Just enter inherit. Inherit is always long-term. And most computer software, if you even type the letter I, it will fill it in with inherit for you. How to figure gain or loss on the sale of property. To calculate your gain or profit or loss on a sale or trade of property, you must first calculate the following. The first is your adjusted basis in the property, and the second is the amount that you realized from the sale. And again, both of these are basis of assets concepts, so I'm not going to spend a bunch of time discussing today how you figure your adjusted basis in an asset. But it's still relevant to today's class, so I'm mentioning it again. Your adjusted basis in property sold is your original cost basis in the property plus and minus certain adjustment items. And the amount that you realized from the sale is everything you received for the property, including cash, notes or mortgages that are payable to you, mortgages or other debts owed by you and assumed by the buyer, and other property or services you received in exchange for the property. Seller financing is another important one. If you finance the sale of property, the amount you realize is the total of all payments you receive over the lifetime of the loan minus interest. This is because all loans are treated as having two components, one of which is interest and one of which is principal. The IRS says you cannot give an interest-free loan, that interest is always there. And if you make a loan to someone and say it's a zero-interest loan, the IRS will say, no, it's not. We don't allow for that. Now, there's a couple of reasons for this, and they really make sense. The first one is, if you sell property at a capital gain, you get capital gain treatment, correct? So there could certainly be an incentive there to say, you know what, let's raise the sales price and make it $100,000 more than the fair market value so that I get capital gain treatment on that extra money, and we'll just treat it as an interest-free loan. And the IRS is going to say, well, no, we're going to look at the lifetime of the payments on that property, and you know, what would a reasonable lender ever be willing to loan on that property for? And we're going to imply that there is interest in the loan, and we're going to reduce the selling price of that property by the amount of interest we think should be in there. And you're going to have to pay tax on that interest at ordinary income rates. So that's the one reason. Obviously, IRS doesn't want you having interest-free loans as a way of maneuvering your way into a lower tax bracket. But the second one, and I haven't really seen it written anywhere, but it is kind of self-evident to me, is when you have very wealthy people who have a lot of money, they may be trying to give it away to their heirs. And there are estate laws and gift tax laws in place to make sure that not too much gets given away without tax being assessed. And I could easily see that someone who is wealthy would try to give an interest-free loan to their children or grandchildren as a way of bypassing some of these gift rules. And again, the IRS is going to be saying, if you've loaned money to someone, you need to be charging interest. And if you decide to give too much interest, then that gifted interest is going to be falling under the gift rules. So if your loan does not state the rate of interest that applies, the IRS will apply a minimum rate of interest. And here's an illustration. It's a very simple illustration and not really indicative of what would happen in the real world, but just to give you numbers so that you can see them. You sell your rental home under a contract sale on January 1, 2010 with a sales price of $150,000. The buyer pays you $10,000 down and agrees to pay you the remaining $140,000 within the next 18 months. Then on January 1, 2011, the buyer pays you $140,000. There is no stated interest amount for this transaction. Even though the interest was not stated, we need to construe that interest was in fact paid. You need to allocate a portion of the sales proceeds to interest at a fair market rate. If the fair market rate for this transaction is 8% per year, then you must subtract unstated interest from the sales price. In this example, unstated interest would be $140,000, the amount that was loaned, times 8%, and that gives you $11,200. Therefore, the true amount realized from the sale is going to be $10,000 down payment plus 140 minus the 11,200, or 10,000 plus 128,800. So the actual sales price is going to be 138,800, and that would be the amount that you'd report as a sales price on 8949 and Schedule D. And unfortunately, this 11,200 amount would need to carry to Schedule B and report it as interest income. Even though there's no formal wording of it in the sales contract, the IRS can come along, audit you, and do that for you. Our job as tax preparers is to notice stuff like that. Help our clients calculate a reasonable rate of interest that would hopefully be much less than 8%. Treatment of capital losses. If your capital losses are more than your capital gains, you can deduct your allowable losses against your taxable income. But the yearly limit on the amount of capital loss you can deduct is $3,000, which is actually a pretty small number. And if you're married filing separate, it's $1,500. So if you just lost your shirt on the stock market, it could take you many, many years to recover that. But when you have a loss, if the loss is more than the $3,000 you're allowed to claim, you are allowed to do a carryover. And you can keep carrying over every year until you use it up or die, whichever one comes first. Short-term and long-term losses. When you carry over a loss, it retains its original character as either long-term or short-term. A short-term carryover to the next year is added to short-term losses occurring in that year. And a long-term loss carryover to the next year is added to long-term losses occurring in that year. If you have both short-term and long-term losses, your short-term losses are used first against your allowable capital loss deduction. If after using your short-term losses you have not reached the limit on capital loss deduction, you can use your long-term losses until you reach the limit. And here is a comprehensive illustration. Now I've managed to squeeze a lot of forms into a tight space on a small piece of paper, and if it's microscopic, so small you can't read it, I apologize. I was just sitting there yesterday trying to fit this information in kind of in one place in front of us, but I'll zoom in a little to kind of focus on the areas I think are important. IRS did say that it's going to be testing on the RTRP exam on carryovers, so I felt it was important to teach you all how to look for carryovers and how to see them on tax forms. So I squeezed them into today's session. In 2009, you had a short-term loss of $6,000 and long-term losses of $8,000 on stock you sold. You claim your short-term losses first, so your allowable 2009 tax return is $3,000 short-term loss. Your carryover loss to 2010 is $3,000 short-term and $8,000 long-term. So let's zoom in on this a little, best I can. And we can see we've got the Schedule D on the front page here. 2009 short-term loss is $6,000, and that carries down to line 7 as our total short-term losses. We have a long-term loss of $8,000, and it carries down to line 15 as a long-term loss. The total of these losses is summarized on page 2 of Schedule D, and they come to $14,000. On line 21 of the Schedule D, we show the amount of loss we're allowed to claim for the year, which is $3,000. So just looking at 3 from 14, we know we're going to have an $11,000 carry forward, and we're going to be allowed to claim $3,000 of loss. But the rule says the $3,000 of loss that we're going to enter on Form 1040 on line 13 is going to be $3,000 of short-term loss. So therefore, the IRS has this carry forward or carryover worksheet. The carryover worksheet shows the amount of loss that's allowed on the Schedule D, line 21, that's carrying to the 1040. It's showing the amount of loss that's short-term, the amount of loss that's long-term, and that the amount of loss being claimed on the return this year is $3,000 short-term, and that the carry forward will be $3,000 short-term and $8,000 long-term. So let's go forward to 2010, the next year, where we're carrying those, and see what happens there. So in 2010, you report short-term gains of $2,000 and long-term gains of $3,000. It's a better year. You subtract your short-term gain from your short-term loss carryover. So you have a $3,000 short-term carryover from 9 to 10, and in 10 you have a $2,000 short-term gain. That means you still have a short-term loss of $1,000 for the year. And on the long-term side, your long-term loss carryover is $8,000, and your 2010 long-term gain is $3,000, leaving you with a net loss of $5,000. So how does that look on the tax form? Well, on the Schedule D, we show a gain of $2,000 as a short-term gain, and we show a carryover loss entered on line 6 of $3,000, and we subtract the 3 from the 2 and end up with -1. Moving down, we have, on the long-term side of things, we have a gain of $3,000. We have a carryover from 2009 of $8,000, leaving us with a net loss of $5,000 for the year. Well, 5 plus 1 is 6. So when we move over to line 16 of Schedule D, we see we have a $6,000 loss. How much of that loss is going to be allowed in 2010? Well, $3,000 of it. And that $3,000 is going to be comprised of $1,000 short-term and $2,000 long-term. And we go over to the capital loss carryover worksheet, and we see that the loss being allowed is 3, that 1,000 of the loss being claimed for the year is short-term. There is no carry forward now because we've used up all of the short-term loss, and that the remaining $2,000 of loss being claimed for the year is long-term, and that we are left then with $3,000 of long-term loss carrying forward to 2011. So let's see what's going to happen now in 2011. In 2011, you report short-term gains of $4,000 and long-term gains of $10,000. It's an up year. You report your short-term gains in full at $4,000, and you subtract your long-term loss carry forward from your long-term gain. 10,000 minus 3,000 means that you're reporting 7,000 of long-term gain. So let's take a look at the Schedule D. And here we see the Schedule D now looks completely different. 2011 is a new year, but the point is the same. We have this $4,000 short-term gain, and down on the next line we see that we have line 10, or line 8 rather, we have a $10,000 long-term gain. But on line 14, we're still entering that loss carry forward from 2010 of $3,000. And that $3,000 is a long-term loss carry forward, so it's going to reduce our long-term gain from 10 down to 7. Ultimately, the gains that we're reporting on the tax return for 2011 are 7,000 long-term plus 4,000 short-term, for net capital gains of $11,000 being reported on line 13. And the bottom line behind all of that is that of this 11,000, 7,000 will get long-term capital gain treatment at the favorable capital gain rates. And $4,000 of short-term gain is going to be taxed as ordinary income. And yes, the IRS, or you could say no, the IRS will not allow you to use the $4,000 of short-term gain against the $3,000 of long-term loss to reduce tax on the short-term gain. Underneath, at the very bottom of this page, I have a table that essentially summarizes what's happening each year. And you can make sense of that or not make sense of it on your own. I'm going to move on now. How do I figure my capital loss carryover? Well, you figure your capital loss carryover using the capital loss worksheet. And I just showed you two separate illustrations of how that worksheet works, one for 9 and one for 10. And of course, 2011 has its own again. And you can find those in the Schedule D instructions on page D7 of the instructions. Death of taxpayer, I already mentioned this. Capital gains cannot be carried over after a taxpayer dies. They can only be deducted on the final return, and the yearly limit still applies. Any excess may not be deducted against the estate. Treatment of capital gains. The 28, 33, and 35% income tax rates for individuals do not apply to a net capital gain. And in most cases, the lower 10, 15, and 25% rates also do not apply either. Instead, your net capital gain is taxed at lower capital gain rates. And so what is a net capital gain? Well, your net capital gain is the gain for the year that is more than the net short-term capital loss for the year. Net capital gains are subject to the lower capital gain rates, and let's take a look at what those are. Now, they were, when I got into taxes 20 years ago, it was 28% was the maximum capital gain rate. And then Gingrich came along, and his Contract of America, we got it whittled down to 20%. And then there were, for a while, there was two capital gain rates, one that applied if you held it more than 5 years, and another one that applied if you held it only 1 year or more than a year. Can't even remember what those two were anymore. But then Bush came into office. And with his Tax Act that was passed in 2001, we ended up with this new 15% rate. And also with what would have been a 5% rate. And those rates were supposed to expire at the end of 2010, but they were reinstated under the Reed-McConnell Tax Relief Unemployment Insurance Reauthorization and Job Creation Act of 2010. So they've now been extended. Those lower rates have now been extended through 2012. So the table that you're looking at here has been around for about 4 years. 4 years ago, actually 3 years ago is when they brought in this 0% rate, which is really quite kind of amazing. But these capital gain rates that you see on here are presumably about to go up unless our government gets together and agrees on something. And quite frankly, if they're looking at sealing the deficit, one of the things they could do is let these go up. Because they will go up automatically if nothing's done to keep them low. So let's take a look at the rates that are on here. The first one is a collectibles gain rate. If you sell a collectible, the maximum capital gain rate is actually not 15%, it is 28%. It doesn't mean that when you sell a collectible, you have to pay 28% tax on it. What it means is that the maximum tax you'd ever pay on it is 28%, and you'd only worry about a rate being higher than 28% if you were in a 33% or higher bracket, say. So most people fall in tax brackets less than 28%, so most people would report profit from the sale of a collectible at their ordinary rate, whatever that is. So if you're in the 15% tax bracket and you sell a collectible for a profit, you would pay 15% on that profit. If you happen to be in the 35% tax bracket and you sell a collectible, then you would only have to pay 28% on the profit. So that's what it means when we see a maximum rate in here. Also, there's something here called gain on qualified small business stock equal to the Section 1202 exclusion. This is a pretty rare animal, but I have dealt with it a few times or a couple times over the years. The maximum gain on a Section 1202 exclusion is 28%. However, you need to read the asterisk down here and see what's really going on. To help stimulate investment in small business, this would have been under Clinton, a 1993 law was introduced to Section Code 1202, which says that you may exclude from taxable income up to 50% of the gain you realize on the sale of qualified small business stock that you acquired after August 10, 1993. The non-excluded portion of the gain on the sale is subject to 28%, resulting in an effective overall rate of 14% for most people. Now, how does you get the math out of that? Well, what happens under a Section 1202 exclusion is that because it's qualifying stock under Section 1202, you only pay tax on half of your profit. But the rate of tax you pay on half the profit is 28%. So in effect, you're paying 14% on the whole profit. Now, under Obama, and part of the Economic Act, this Reed-McConnell Act up here, the exclusion has been improved or increased. The exclusion can be up to 75% of the gain on stock acquired after February 17, 2009, and up to 100% for stock acquired after September 27, 2010, and before January 1, 2012. And this actually may not fall under the Reed-McConnell. It's going to be one of those other acts that was passed early in Obama's administration. So it fit into one of those. So if you have stock that was acquired in this very narrow window of time, which is, of course, in recent history, you may not have to pay any tax on the gain at all if you fall into that 100% exclusion. But if you fall into the 75% exclusion or the 50% exclusion and then you sell that stock, you figure your profit, you reduce that profit by 75% or 50%, whichever applies, and then whatever the balance left is, you multiply that balance by 28%. So that's what this category here means, gain on the sale of Section 1202 exclusion stock. The next one we come to is Section 1250 gain, unrecaptured Section 1250 gain. What does the word unrecaptured mean? Well, we're going to cover that later, but it essentially has to do with a recovery of depreciation on real estate. And to the extent that you are selling real estate at a profit, and any portion of that profit can be due to depreciation that you've claimed in the past, you're going to pay a maximum rate of 25% on the recovery of depreciation. Other gain and your regular tax rate that would apply is 25% or higher. Your capital gains are going to be taxed at 15%. And other gain and your regular tax rate that apply is lower than 25%, then their maximum gain rate is 0%. And this 0% is quite remarkable. Sometimes we scratch our heads over it because we'll have a client that might have sold $30,000, $40,000, $50,000 worth of stock or have a profit of $30,000, $50,000 for the year on their stock, and then the software says their tax is 0. And my tax preparers are coming to my office and saying, the computer's saying their tax is 0. I'm confused. So it is technically possible for that to happen. So let's take a look at a little bit on how that's calculated in a minute. Just before we get to it, though, we are going to talk about qualified dividends.
Password number 1 is SAMWISE, SAMWISE, SAMWISE.
If you received qualified dividends, your dividends qualify to be taxed at the 0 and 15% rates instead of the ordinary income rates, but the dividends do have to be qualified. To qualify, a dividend must be received on a stock that is held for more than 60 days in the 121-day period beginning 60 days before the ex-dividend date. You report qualified dividends on Form 1040, line 9A and 9B. You then use the Schedule D or the Qualified Dividends and Capital Gain Tax Worksheet, whichever applies to you, to actually figure the tax. There is an exception to that 60-day holding period. If you hold preferred stock, you actually have to hold it for 90 days before and after in the 181-day period. Qualified dividends are not included in investment income. We covered investment income and the deductibility of investment interest in our CPE course called Wage Investment and Other Income. So I'm not going to explain how it works today, but I just wanted to remind you that qualified dividends are not considered to be investment income for purposes of the investment interest deduction unless you make an election to have your qualified dividends taxed as ordinary income. And how you do that would be on Form 4952. Now here's an illustration of qualified dividends and how they work, and also how to complete that qualified dividend worksheet to figure your capital gain and rate of tax that's going to apply to those qualified dividends. James had $50,000 of wage income for the year. He also received a 1099 DIV that reported $5,000 of dividend income in Box 1A and $4,500 of qualified dividend income in Box 1B. His Form 1040A is shown below. Figure his tax using the Qualified Dividend and Capital Gains Worksheet as shown next. So we have line 9A where we're reporting the total dividends received, and on line 9B we report the portion of those total dividends that are qualified dividends. And we threw in some wage income there. Wait a sec, this says 43. This is supposed to be 50. I've already found the first typo in the manual without realizing it. Okay, so his wage income is 43, folks. Torturing myself here. All right, so his wage income is 43. He has $5,000 of dividends, $4,500 of qualified dividends for a total adjusted gross income of $48,000. Let's go over and figure out how much tax he owes on that. Well, he's just going to claim a simple standard deduction of $5,800. And he also claims an exemption deduction of $3,700 to arrive at a number on line 27, which is his taxable income. And he can go to the tax tables to look up the tax on that, but if he were to do that, he would come up with a number that is too high. Because the tax tables only show ordinary tax, they don't show the special lower tax rates for capital gains. And in order to figure out how much tax he really needs to enter here on line 28, he's going to have to do the worksheet. So let's get on to the worksheet. So we begin the worksheet by showing his taxable income from line 27 of the 1040A. Then the first command we have is to enter the amount of qualified dividend showing on Form 1040A line 9B, and that's the $4,500. We subtract the $4,500 from his taxable income to arrive at a number which is his income without regard to the dividend income. And this is a number that we're actually now going to go to the tax tables and look up the rate of tax on, see how much tax he owes on that $34,000. The next step is to figure out what portion of the qualified dividends that he received qualifies for the 0% rate and what portion qualifies for the 15% rate. And it turns out that you have to use this base amount to figure that out. And if I zoom in on this worksheet closer, you'll see that the base amounts are printed right here, and they vary according to your filing status. $34,500 for single or married filing separate, $69,000 for married filing joint, or $46,250 if head of household. What these magic numbers represent is the point at which a filer in that tax bracket moves from the 15% bracket into the 25% bracket. So to the extent that our filer's income is less than these numbers, he is in the 0% bracket for purposes of tax on the qualified dividends. So how much is his income when we subtract out the qualified dividends? Well, it came out to be $34,000, right? That's this number on line 7. So $38,500 minus the qualified dividends leaves us with $34,000. And how much is $34,000 with regards to this threshold amount of $34,500? Well, it happens to be $500 less than that. So what it means is $34,500 minus $34,000 equals that $500, and that means $500 of his qualified dividends will be taxed at 0%. And the remaining amount of qualified dividends, $4,000, is going to get taxed at 15%. So the worksheet says, okay, calculate out the 15%, and when you do that, you get $600. And I already told you he needs to go to the tax tables and look up the tax on $34,000, so he does that. And when he calculates the tax on the $34,000 in the tax tables, he comes up with $4,679. The next command is to go to the same tax tables and look up the tax on $38,500. And if he were to do that, then he comes up with $5,756. So $5,756 is a higher number than what he gets when we take $4,679 and add $600. So $600 is the rate of tax on the qualified dividends, $4,679 is the tax on all other income that is left, and they total $5,279. If he were to go to the tax rate tables and look up the tax on line 1, he gets $5,756, which is clearly a few $100 higher. So he is definitely benefiting from the reduced capital gain rates, and the amount on line 19 is the lower of the two tax calculations, and that is the amount that he will carry and enter right here on line 28. So the next topic we're going to look at is sale of business property. We're going to talk about it a little, then we're going to talk about some other stuff, and then we're going to come back and really focus on it. When you dispose of business property, your taxable gain or loss is usually a Section 1231 gain or loss. The treatment as ordinary or capital is determined under the rules for Section 1231 transactions. And when you dispose of depreciable property, either Section 1245 property or Section 1250 property at a gain, you may have to recognize all or a part of that gain as ordinary income under the depreciation recapture rules. Any remaining gain is Section 1231 gain. Well, what does all of that mean? Well, we're going to show you. So what is Section 1231 property? Property that is held and used in a business for more than a year is generally considered to be Section 1231 property. And the sale of a Section 1231 business asset is generally considered to be the sale of a capital asset, and the net gain or loss from the sale is treated as a long-term capital gain or loss. The following assets are Section 1231 assets. They include Section 1245 property, which is any property that is or has been subject to an allowance for depreciation or amortization, and Section 1250 property that is real property. So real property is real estate. It's buildings, it's vacant land, it's anything built on land, growing on land, attached to the land. That's real estate. And everything else you use in a business for purposes of income production, such as assembly lines, automobiles, computers, copiers, those are all Section 1245 assets. Also, intangibles that are used in a business, things like goodwill, going concern value, patents, copyrights, things of that sort, are also considered to be Section 1245 property. So whether the property is intangible or tangible it's still Section 1245 property because the only property that's Section 1250 property is property that is real estate. So Section 1231 gains and losses. Section 1231 gains and losses are taxable gains and losses from Section 1231 transactions, and how you treat the sale depends on whether you have a gain or a loss. A Section 1231 loss is an ordinary loss reported on Form 1040, line 14. Line 14 is a very important line when you're losing money, because earlier when we looked at that carry forward illustration, we saw that line 13 can never be more than -3, correct? Negative 3,000 is the biggest negative number you can ever put on line 13. Your software, no matter how hard you try, would never let you put more than -3, I would hope, on that line. But line 14 has no similar restriction. You can have negative $1 million on line 14 if you can manage to muster that number up. You can put it there. So in other words, when you sell an asset used in your business for income production, when you sell that asset, it's not going to be treated as capital loss. It's going to be treated as ordinary loss, and the loss is claimed on line 14. But oddly, if you take that same capital asset and sell it at a profit, the profit will be reported on line 13 to the extent that the profit is due to an increase in value over the purchase price. If the profit is due to recapture of depreciation, or to the extent that the profit is due to recapture of depreciation, the portion of the profit that is for recapture of depreciation is reported on line 14, and the portion of the profit that is due to increase in value from the original purchase price is going to be entered on line 13. So in effect, profits go on line 13 and losses go on line 14 when you sell a Section 1231 asset. Now let's further define this a little bit by looking more closely at Section 1231 and dividing it into its component 1245 and 1250 parts. So Section 1245 property includes any property that is or has been subject to an allowance for depreciation or amortization, and which is one of the following types of property. Personal property that is either tangible or intangible, and certain other tangible property except buildings and their components. When you sell Section 1245 property, ordinary depreciation recapture is entered on line 14, and losses on the sale of Section 1245 property are also always entered on line 14. But if you sell a Section 1245 asset at a profit, the profit goes on line 13, to the extent that the profit exceeds the recapture of depreciation. All right, let's compare that to Section 1250 property, because you can see on the Section 1231 illustration and on the Section 1250 or on the Section 1245 illustration, I've got the yellow bar and the pink bar both highlighted, because whenever you're dealing with Section 1231 transactions, that transaction could include Section 1245 property, and Section 1245 property is the property where you're going to have a loss on line 14 as well as a profit on line 14, to the extent the profit is due to a recapture of depreciation. But when you get down to Section 1250 property, things are treated a little bit differently. And of course, again, Section 1250 property includes property that is real estate, and most leasehold of land and buildings are Section 1250 property. The recovery tax rate on Section 1250 property is 25%. Of course, when you enter a recapture of depreciation on Section 1245 property and it is entered on line 14, it's going to be taxed at your ordinary rate. There's no capital gain treatment, no special treatment. It's taxed at your ordinary rate. But when you're dealing with a sale of Section 1245 property, you do get special tax treatment even on the depreciation recapture portion, which is why when we deal with Section 1250 property, it's not called a recapture. It's called an unrecapture or a recover. So you unrecapture gain on Section 1250 property. You recapture gain on Section 1245 property. Now, the recovery tax rate for depreciation on Section 1250 property is 25%. However, this rate applies only when your taxable income is less than the amounts shown here. So these are the rates that you move into the 25% bracket. So it's only when you're in a bracket lower than these that Section 1250 gains would actually be taxed at your ordinary rate. Once you hit these tax brackets, your rate is 25%, and once you get into the 28% or higher brackets, you're going to pay less tax on recovery of depreciation on the sale of 1250 property than you would on Section 1245 property. So when we're looking at Section 1250 property and you have a capital gain on that property, the capital gain carries to line 13 and is taxed at capital gain rates. And if you sell real estate on which you've claimed depreciation, the portion of the depreciation that you recover on the sale is also reported on line 13. The only time Section 1250 property ever ends up on line 14 is when you sell it at a loss. Because if you sell a business use asset, even real estate at a loss, and that real estate is used in a trade or business, that's what makes it Section 1250, the loss is allowed on line 14, so it's not going to be limited to $3,000 a year. There's a question in the classroom, is there a difference between acres and makers depreciation on the treatment? The answer is no. Acres and makers are both our depreciation systems under which recapture has to be accounted for. However, depreciation on assets that began before 1981 is typically referred to as non-recovery property. And on those properties, you would use your depreciated basis as your cost for determining a gain, but all of the gain would be capital gain and you wouldn't have to deal with a recapture or a recovery if it was sold, or not if it was sold, but if it was acquired and placed in service prior to 1981. But that's going to affect a very small number of people. Most people who have business assets in use either started depreciation under acres or makers, and in both cases, the recapture rules apply. And we are going to move on to a discussion of non-taxable trades. In general, the only kind of non-taxable trade is a Section 1031 like-kind exchange. And we're going to cover the 6 rules that must be met in order for a trade to meet the requirements of being given like-kind exchange treatment. Like-kind exchange treatment allows you to defer the gain or put off into the future at some later point paying tax on your profit on this trade. So like-kind exchanges can be a good deal. People like to engage in transactions that are like-kind exchanges because they can put off paying tax doing it. But a trade is not a like-kind exchange just because you decide it is. You actually have to pass the tests. So we're going to cover those. Test number 1, the property must be business or investment property. Property you hold for use in your business or investment includes things like office equipment, rental property, and land. Personal property such as your car or home does not qualify for Section 1031 treatment. Test number 2, the property cannot be inventory or other items held primarily for sale. Merchandise you hold for sale is not eligible for special treatment under Section 1031. Test 3, the property cannot be stocks or bonds. Separate special rules apply to the sale of stocks on bonds. There must be a trade of like property, and this is what we get into. Do we have a like-kind exchange? Because in order to have a like-kind exchange, we have to trade like property for like property. And the IRS or the regulations describe what is like property. Firstly, IRS says real estate for real estate is like property. The exchange for city property for farm property or unimproved property for improved property is considered a like-kind exchange. However, real estate within the United States traded for real estate in a foreign country is not considered to be a like-kind exchange. So if you trade a vacant lot for a commercial office building, that is a qualifying like-kind exchange. But if you trade a vacant lot in the United States for a vacant lot in Canada, that would not be a like-kind exchange. Question. There's a question already coming up in the room. Does the value come into play? And absolutely, how much of the gain you can exclude from taxation would be very much dependent on the value of the property. And if you trade 2 properties of exactly equal value, there would be no tax due in that like-kind exchange. But if there is a difference in the value of the property given up for the value of the property you are receiving, then that difference is compensated for by something called boot. And boot can trigger a taxable transaction. So depreciable tangible property can be either like-kind or like-class. This means property need only be in the same general asset class to qualify for like-kind exchange treatment. Examples of like-kind property in the same class include office furniture, fixtures, and equipment. That is that a desk can be traded for a chair because they fall into the same class. Information systems such as computers and peripherals are also considered to be like-class. Calculators and photocopiers are considered to be like-kind assets. Breeding sheep and breeding goats are considered to be like kind, and automobiles and taxis are in the same kind, are class and are like kind. Examples of not like kind property include a light general truck over 13,000 pounds is not in the same class as a heavy truck over 13,000 pounds. A breeding horse over the age of 12 is not in the same class as a breeding horse under the age of 12. And assets used to produce sugar products are not in the same class as assets used to produce grain products. For more information on classification of assets, you can refer to IRS Publication 946, Appendix B. And of course, in our last class on depreciation, I got really excited and showed you all about that table. Test number 5. Property to be received must be identified within 45 days after the date you transfer the property that you gave up in the trade. And finally, test number 6, these have to do with time requirements. The property to be received must be received by the earlier of 180 days after the date on which you gave up your property, or the due date, including extensions for your tax return for the year in which the transfer of property occurs. Real estate for real estate like-kind exchanges. Most of us, when we think about a like-kind exchange, we think about real estate for real estate, don't we? Because at least that's what our customers are asking us about. And if we've ever bought or sold a home, the purchase or sale of a home that we've personally been involved with might have been involved in a like-kind transaction. Maybe because we were doing it, or maybe because the buyer of the seller on the other end of the deal was involved in it. I personally know I sold a house a few years ago, and the people buying it were doing so through a like-kind exchange, and it was a royal pain in the butt. So if you are the person who is trying to perfect a like-kind exchange, typically you're trying to do it because you want to defer paying tax. But if you're on the other side of the deal and you're not involved in the like-kind exchange, you're just trying to sell or buy property, being in that transaction is painful. And the reason it's painful for the person not a part of the like-kind exchange but is a part of the transaction is these requirements that the person who is trying to perfect that like-kind exchange are trying to meet. And they don't want to close on your property until they've got this other property falling in that time window. Now, having said that like-kind exchanges, we think of real estate, there's actually like-kind exchanges that probably happen more often than real estate, and we don't even know it's happening. And that part that I'm referring to is car trade-ins. How many of us have ever traded in a car for another car? Okay. If we use our car in our business and we trade it in for another car, we just had a like-kind exchange. So that is probably the most common like-kind exchange, and I bet you all kinds of people don't even realize that they had them. So here's an illustration. Assume that your old car has an adjusted basis of $15,000 and that in addition to trading in your old car, you pay $10,000 of cash for a new car. The basis of your new car is the adjusted basis of your old car plus or minus any boot given or received. So the cost of the old car is $25,000. You have $10,000 of accumulated depreciation, giving you an adjusted basis in the old car of $15,000. The new car has a sticker price of $30,000, but you're not going to have to give them $30,000. Instead, you're going to give them your old car with an adjusted basis of $15,000, and you're going to bring cash or a boot to the table of an additional $10,000. So your cost in the new vehicle is $15,000 plus $10,000, giving you a basis in the new car of $25,000. In this example, your adjusted basis is $25,000, and your holding period for the new car begins on the day following the date that you acquired the old car. And if you're just pin and needles wanting to know more about like-kind exchanges, you have to stay tuned for my class next Tuesday. We're on to the next topic now, which is transfers to spouse. Generally, no gain or loss is recognized in a transfer of property to your spouse. If you receive property from your spouse, your basis and holding period is the same as your spouse's basis and holding period. Related party transactions. If a gain is recognized on the sale or exchange of property to a related person, the gain may be ordinary income even if the property is a capital asset. A loss on the sale or exchange of property between related persons is not deductible. For more information on that, read Publication 544. Now, in our last class on depreciation, there was a question that came up. What happens if I have my personal residence, I paid XYZ dollars for it, let's just say $200,000. It dropped in value to $100,000 and then I turned it into a rental. What happens then when later on I sell it? And my answer in the class that day off the top of my head was, well, I think the gift rules would apply. It would depend on whether you sold it at a gain or a loss, and if you sold it at a gain, you'd go to your cost, and if you sold it at a loss, you'd go to the fair market value on the date of the conversion. There was a little bit of a discussion in our classroom. I had an attendee who was arguing with me, so I said I would put it in the manual after I looked it up, and I win. So, so here we have it. The answer is in publication 551, which is on the basis of assets. And I basically copied it verbatim in here without much time to really think of better wording. If you hold property for personal use and then change it to business use or use it to produce rent, you must figure its basis for depreciation. An example of changing property held for personal use to business use would be renting out your former main home. Your basis for depreciation is the lesser of the following amounts: the fair market value of the property on the date of the change, or your adjusted basis in the property on the date of the change. Sale of property. If you later sell or dispose of the property changed to business or rental use, the basis of the property you will use depends on whether you are figuring gain or loss. And if you are figuring a gain, you figure your gain using the adjusted basis when you sell the property. And to figure the loss, you use the basis that was adjusted based on fair market value. So again, they're not going to make you pay tax on a spread between the difference in fair market value when you placed it in service and what the appreciated value was at some point later in time. They would allow you to go to the higher basis, which is what you paid for it. But conversely, if you have a house that you pay $100 for, you convert it to a rental when it's worth $100, and then 2 years later you sell it for $75, they're going to allow you to realize a loss between that $100 and that $75, not between the $75 and the $200 you originally paid. Because that depreciation or drop in time while it was held for personal purposes, that's a personal loss and not a business loss. So it makes perfect sense. Reporting gains and losses. How you report a gain or loss depends on the nature of the property you sold and the manner in which you sold it. Everything in the world depends on this. If you sell property that is a business asset, that sale gets reported on 4797. And if you sell personal property or personal investment property, then that sale is reported on 8949 and Schedule D. So there's two different forms that are used frequently for reporting sales. Now, most individuals do not own businesses. They're never going to be involved in the sale of a business. And so most individuals do not complete Form 4797. But it is possible, even as an individual who is not a business owner directly, to end up having to file Form 4797, and that happens if you happen to be an owner in a publicly traded partnership or any partnership at all. That can trigger a sale that does need to be reported on Form 4797. So we're going to look a lot at 4797. We're going to look a lot at Schedule D and talk about a few other things along the way as well. So in general, when you sell personal use property, you report the sale on Schedule D and Form 8949. But you don't normally need to report the sale of personal property because most personal property, frankly, you buy it, it drops in value, you sell it at a loss, and you're not allowed to claim the loss, so the sale just isn't reported at all. But of course, if you buy personal property and it goes up in value and then you sell it, Uncle Sam wants a piece of it. Now, sometimes even when you sell property at a loss, you're still going to need to report the loss, and that happens most commonly with real estate because there is a document that is issued when you sell real estate. And that document is called a 1099-S. Form 1099-S is used to report the sale of real estate. Typically, it is not issued if the property sells for less than $250,000 for a single person or less than $500,000 for a married person, because at the time you're closing on the sale of your home, you are asked to sign a statement, and the statement basically certifies that you meet the time requirements of having owned and occupied the house for 2 out of 5 years. If you sign off on that and the sales price is less than $250,000 for single or less than $500,000 for married, the 1099 usually isn't issued. Although sometimes I still see it get issued, probably because they didn't sign the piece of paper. Or maybe they did sign the piece of paper and it still got issued. But if the sales price is over $250,000 for a single person or over $500,000 for a married person, then it is to be expected that a 1099-S should always be issued. And when a 1099 is issued to the government, it doesn't show cost basis. It only shows the sales proceeds. And so if IRS receives a 1099-S showing sales proceeds of $400,000, and they don't have any kind of corresponding tax return being filed on that, they're going to assume that that taxpayer owes tax on $400,000. So we need to file a Schedule D with a Form 8949 to tell the IRS that, hey, this is not a taxable sale, or maybe it's only a partially taxable sale because we're going to be claiming that exclusion from gain. So let's take a little bit of a look briefly here at sale of home. In our next class on Tuesday, we take a deeper, more in-depth look at sale of home, but today I just wanted to touch on it. Generally, if you owned and occupy your main home for 2 out of the last 5 years, and your gain is $250,000 or less, or $500,000 or less if you are married, then you do not need to report the sale at all. And if you have a profit that is within those parameters, you don't pay tax on the profit. However, if you do get the 1099-S, there's no way around it. You do need to report it. And here are the instructions on how you do that. You complete the Schedule D sale of home worksheets to determine your cost basis and the amount of gain or profit that you have from the sale. You then report the gross proceeds shown in Box 2 of the Form 1099-S in Part 2 of Form 8949 with Box C checked. What's 8949 Part 2 Box C? Well, I'll show you that. Then in column A of that same form, you provide a description, and the description would be main home. Then in column B, you enter reason code H. In column C, D, E, and F, you enter the sale and cost basis information as you normally would on the sale of property. And then in column G, you enter the gain that you are excluding under Section 121. You carry the amounts from 8949 to Schedule D, Part 2. Now here is a 1099-S, and by now, if you've been in taxes for any length of time, you should have seen lots of these. They are, of course, used to report the sale of real estate. And this is one of the documents I don't really see a substitute document for. In other words, when a sale is reported on 1099-S, my client comes in with a 1099-S filled out, and it looks exactly like this one. I don't see substitute statements, unlike Schedule Ds or 1099-Bs and 1099-INTs and 1099-DIVs, which I see substitute statements more than I see statements that look like the ones we illustrate from IRS. So this statement will simply show the date of closing, the amount that was sold for. So this gross proceeds in Box 2, that's the amount that the IRS is being told you made on that sale. And then down in Box 5, it'll show the buyer's part of real estate taxes. If you are the seller and buyer pays some of your real estate taxes for you, you're not going to be allowed to claim a tax deduction for real estate taxes that you paid and then the buyer reimbursed you for. So that's what Box 5 is about and how you work with that. We discussed that in our itemized deductions class. And here is an illustration on how to perfect a sale of home on your tax return. Betty and Peter Pan sold their home at a tidy price of $742,000. They had no selling expenses, and they'd been in that house for a very long time. They have a profit or gain on the sale of $660,000. The Pans are married and are filing a joint return. They meet the ownership and use tests, which means they qualify to exclude $500,000 of gain. The remaining gain of $160,000 is going to be reported on Schedule D and is taxable. Let's see how their tax form should work out. The first thing we have in the background is Form 8949. And I meant to zoom. There we go. So you can see right here it says 8949. And on the form, we describe in Part 2, with Box C checked, the description is main home. We enter a code in column B, and the code in column B represents the amount of gain that's not going to get taxed, code H. It's telling the IRS that this is a Section 1230 or 121 exclusion. That's what that means when we put a code H there. We enter the date bought, the date sold, the sales price, the cost, and then we enter the amount of gain that we are excluding and don't have to pay tax on. These numbers on the 8849 carry down and get totaled at the bottom of the page on line 4. And then you carry the entries from line 4 up to the Schedule D and enter those in Part 2 of Schedule D on line 10 where it says long-term totals from all forms 8949 with Box C checked in Part 2. So all of these numbers carry right over across the board. The only number that's different is this gain number. The 8949, irritatingly I have to say, does not show gains on any of the lines. I find it excruciating that it doesn't, and I'm hoping IRS will maybe adjust for that. Because when you're going through and trying to see, hey, do I have a total here that means something, you can't tell. You'd have to essentially start doing manual totals. There's nothing calculating for you off in the margin. But when you carry it over to the Schedule D, then the profit is shown on the Schedule D, and in this case it's $160,000. Now, if you sell stocks, bonds, or commodities and you receive a Form 1099-B, proceeds from broker and barter exchange transactions, you are required to report all taxable sales of these stocks, bonds, and commodities on Schedule D and Form 8949. The sale of stock is subject to some additional rules that do not apply to the sale of other property. One of the more important rules concerns wash sales, and that's what we're going to talk about here. A wash sale occurs when you sell stock at a loss and then repurchase the same stock within 30 days prior to or after the sale. Under the rules for wash sales, you are not allowed to claim a loss on your sale if it is a wash sale. So if you buy stock, sell it, and then immediately repurchase it again, the first sale, if it produced a loss, you're not allowed to claim the loss. That's what the wash sale rule means. So here's an illustration of how it works. Your basis in XYZ stock is $1,000, and you sell XYZ stock for $750. Then within 30 days from the sale, you buy the same stock for $800. So you can see you buy for $1,000, sell for $750. That's a $250 loss, and you are not allowed to claim it because you repurchased that same stock within 30 days. Next stock, your basis in ABC stock is $2,000. You sell the ABC stock for $900. That's an $1,100 loss. And then within 30 days, you purchase that same stock again for $800. You're not allowed to claim either loss because of the wash sale rules. So what you do is the loss is disallowed, and the portion that is lost that is not allowed adds to your basis. So you sold for $750, bought for $800. The loss not allowed is $250. So you take the $250, add it to the $800, and your basis in the stock has just jumped up to $1,050. For the ABC stock, you buy for $2,000, sell for $900, producing a loss of $1,100. You then rebuy for $800. The loss is not allowed. It adds to the cost of the new stock, giving you basis in the new stock of $1,900. Beginning with tax year 2011, Form 1099-B provides space for reporting disallowed losses from wash sales in Box 5. And I already did see some, not too infrequently, clients coming in with 1099-Bs where the wash sale box was checked, which is triggering a disallowance of that. So we're looking forward to a future there where those wash sales are going to be pretty much an automatic thing that we're not having to sort through anymore. But I can remember when I first got into this business about 20 years ago, sitting there manually figuring out wash sales for my clients. And this was in the late 90s, the mid to late 90s, where everyone was day trading all the time. And I had clients that come in and literally had hundreds of trades. They had no basis calculations. They weren't being given them by their brokers. And I was having to sit there and go through all the trades and figure those wash sales. Talk about a nightmare. So things have actually improved. Back then, I wasn't smart enough to use Excel either. I was doing it on sheets of paper. I was a beginner. All right, 1099-B. We're going to take a little bit of a look at 1099-B. That's one of the big, huge changes coming into 2011. And guess what? IRS has already changed it again for 2012. But today, we're going to be looking at the 11 changes because we're talking 2011 law. And what has caused all these changes? What's all of the confusion about, or why are they doing this to us? Well, the General Accounting Office did a study, and the study showed that 7 million taxpayers, more than a third of those who sold securities, may have misreported capital gains and losses, and about half of them did so because they misreported their basis. A new law aimed at reducing basis reporting errors by taxpayers began phasing in 2011. The law requires basis reporting on Form 1099-B proceeds from broker and barter exchanges for publicly traded securities. The new reporting requirements apply to stock purchased after 2010. Form 1099-B is revised for 2011, and space is now provided to report the following information that did not get reported in earlier years. In Box 1B, we actually have a place now for the date the stock was acquired. Box 3 now has a spot to enter the cost or other basis of the security being sold. Box 5 provides space for entering the wash sale that was disallowed. Box 6 provides a point where you can check to say that the security is a non-covered security, which means none of this information up here is filled in. And we may have noticed for most of our transactions in the 2012 tax season for 2011 returns that Box 6 was checked a whole lot of the time. And the reason for that is Box 6 can be checked for any security that was purchased before 2011. And it can also be checked for mutual funds purchased before 2012. So any mutual funds that were purchased in 2011, the basis reporting requirements are not in play for 2011 on mutual funds. And for bonds, options, and other securities purchased after January 1, 2013, the basis reporting requirements begin. So even now that we're in 2012, people who are dealing in those bonds and options still don't have to be doing basis reporting for the 2012 year either. A non-covered security is one that was acquired before these dates. Individual investors are responsible solely themselves for reporting gains and losses on non-covered securities to the IRS. Box 8 also has a checkbox in it now to indicate the type of gain or loss. Was the gain short-term or long-term? And here is a picture of 1099-B. Now, of course, this is the IRS's standardized version of 1099-B, and much like a W-2, it's big with boxes, and you put numbers in it. The problem with 1099-B is we never actually see them look this way. So when I spend time talking about 1099-B, what I want you to focus on is the name given to each box. 1A, date of sale or exchange. The 1A, date of sale or exchange, is what's relevant to you, not where on the page it is, because most 1099-Bs are substitute 1099-Bs. They're not going to look like this, but they're going to have the same title and line description. So it's the title and line description that you need to be focusing on. Line 1B is the date of acquisition, and 1B will be blank if box 6 is checked. If box 6 is not checked, then the date of acquisition should be entered. Then we have box 2, sales price of the stocks or bonds, and the IRS now provides a check mark to indicate whether that's the gross sales price or whether it's the sales price less commissions and option premiums. Then we have box 3, which is where we enter cost basis. Cost basis will only be reported for securities purchased in 2011 or later. So if the stock was purchased in 2010, it would not have an entry in box 3. Now, there would be nothing out there that would prevent a securities company from entering a number in box 3 for cost basis, even if the stock was purchased before 2011. It's just that they're not required to. And my observation is that the brokerage houses have not done anything they're not required to do. In fact, I found a few brokerage houses that were checking box 6, marking a transaction as being non-covered, when in fact I could tell that it was covered and should have had it entered. So I bet there's all kinds of brokerage houses out there that have been scrambling trying to catch up with these rules. Then in box 4, we enter federal income tax withheld. Box 5 is where the wash sale loss disallowed would be entered. So presumably if we have cost and we have sales price, and the sales price is less than the cost, we would have a loss. And if this is a wash sale, then box 5 would have a number in it representing the amount of wash loss not allowed. Box 8 shows where you can indicate that it was short-term or long-term, and again, box 8 will be blank if box 6 is checked. Box 9, we enter a description, and then you can see we have a space in here for the account number, QSIP number of the stock, profit or loss realized in 11 on closed contracts, and so forth. One of the things I observed on this 1099-B is it provides no space to enter the number of shares exchanged. And that is one of the improvements for the 2012 1099-B. It is providing space for the number of shares, because quite frankly, if you're reporting the sale of shares, you need to report the number, I think, that were sold, and there's nowhere on the form currently for that, but 2012 it will have it. Okay, I'm just looking down and I see some of my webinar students have been chatting me some questions. Let's read them. Nancy says, is trading a foreign real property for another foreign real property like kind? Well, I would say it is. I haven't had to think about that one, but I would say foreign for foreign would be, yeah. And then Suzanne says, what if you sell real estate held as investment property owned by a business? Is that Schedule D or Form 4797? Well, if the business holds the property for investment purposes and is not using it in the trade or business for production of income, then it would be a capital asset and it would be reported on Form 8949 and Schedule D. But if the real estate is used for income production by the business in the business activity, then it would go on 4797. Got it? All right. Now we're going to take a look at Form 8949, Sale and Other Dispositions of Capital Assets. Obviously, with all of this new information being reported on 1099-B, the IRS had to come up with a system of accommodating that. And the system itself, although it makes sense, is complicated. Getting all the rules set in the mind is difficult, and I observed a good number of my preparers on my staff, even after I explained it to them, were making errors, that they weren't getting it. So if you hear me explain it and then tomorrow you can't remember a word I said, that's why you've got the manual. So the manual is there to help you. Yeah, the 8949 is a brand new form for 2011. The particular section I'm about to cover here now, I covered in my update class in January of this year. I spent a great deal of time studying the form, putting together the material that you're looking at now and teaching it, including to people on my own staff, and I observed that even after a good lecture on it, people were still confused. So I would say after I teach my class today, look back on the tax season and think about the things you were doing. I would not be surprised to hear a lot of you were making mistakes. And I think the IRS is probably trying to clean up a bunch of tax returns, or we'll be looking at a bunch of tax returns trying to figure out how to resolve this issue. But the form itself has very specific rules, and it gives you instructions on what you're supposed to do. And if you don't follow those instructions, then, well, you're doing it wrong. Now, one of the first things that I saw going on was that tax preparers were trying to file tax returns before the 1099-Bs came out. Now, I do not see how you can possibly file an accurate tax return knowing what a 1099-B is going to say when you don't have the 1099-B. Now, why would you file a return before you have the 1099-B? Well, you might have a client who's really anxious to file. And he's got a listing of all his trade activity. He knows what his trades were. He knows what his cost is. He knows what his profit is. Does he really need to wait for the 1099-B? Well, it's not like a W-2 where you're showing tax withholding where there's a requirement to wait. Now, you can file. But the question is what you file going to trigger an IRS CP 2000 letter because the tax return filed does not match the 1099-B when it is eventually filed? So the whole purpose of Form 8949 is to match reporting on the tax return to the 1099-B and to explain any differences between the tax return and the 1099-B, and you can't do that if you don't have the 1099-B. So much as I personally had clients who were anxious to file, I was telling them no, and when I had staff coming to me saying, my client wants to file, can he? I would say he shouldn't, but he really, really, really wants to file. He really wants his refund, and I said, well, we can do that. But if the 1099-B comes out and it is not a match to what we put on the return, they're going to have to pay us to amend it, or they're going to have to deal with the CP 2000 letter when and if it comes out. So it was a gamble. And these brokerage houses, a lot of them don't get their 1099-Bs out till mid-March. So lots of people like to file before then. So let's take a look at what's going on with 8949. This is a very long section of the class, and I don't have time in the allotted time of today to go through all of the reading with you. So I'm going to skip most of the words, let you read them quietly in your own time, and kind of focus just on what I can explain from my head. But I will point out a couple of things first. You use Form 8949 to report all sales and exchanges of capital assets, including stocks, bonds, and real estate, except where those sales are reported on Form 4684, 4797, 6252, 6781, or 8824. Now, 4684 is casualty loss, 4797 is sale of business assets, 6252 is installment sales. Can't remember what 6781 is, and 8824 is like-kind exchanges. So if you deal with any kinds of those transactions, you would not fill out 8949. You would fill out these other forms instead. And of course, the form itself is divided into two parts. Part 1 reports short-term gains and losses, and Part 2 reports long-term gains and losses. And let's take a look at 8949 broken into its component parts. And here I am looking at Part 1. And you will observe that in Part 1 we've got Box A, short-term transactions reported on Form 1099-B with the basis reported to IRS. Box B, short-term transactions reported on Form 1099-B, but basis is not reported to the IRS. So if we have a 1099-B where there's a number in Box 2, that would mean that we've got basis being reported to IRS, right? But if box B is checked, or if box 6 is checked, then that means basis is not reported to IRS. So if the basis is reported to IRS, you would check box A. If the basis is not reported to the IRS, but you do have a 1099-B for the sale, you would check box B. And if this is a sale that was not reported to the IRS on a 1099-B, then you would check box C. So a 1099-S, is that a 1099-B? No, a 1099-S is not a 1099-B, it's a 1099-S. That was not a trick question. Therefore, if you have a 1099-S, you would check box C. Okay, so the only time you check A or B is when you're holding the 1099-B. You're looking at that 1099-B or you're looking at a substitute 1099-B. That's when you check box A or B. And if you have any other kind of sale that is not on the 1099-B, you check box C. Now, you would only check box A, B, or C in Part 1 of Form 8949 if the transaction is a short-term transaction. That means the asset was held a year or less. Now let's move on to Part 2 of the form. In Part 2 of the form, we deal with long-term transactions, and Part 2 fairly much looks the same as Part 1. We can see in Part 2, though, that we are reporting long-term capital gain transactions. Long-term means it was held more than a year. And if you received a 1099-B where cost basis is reported to IRS, you would check box A. If you receive a 1099-B and cost basis is not reported to the IRS, you check box B. And if you did not receive a 1099-B and you are reporting a sale that has no 1099-B at all, you would check box C. That makes perfect sense, right? Now, if you don't have your 1099-B, how would you know that they've reported the basis or not? So you wouldn't even know what box to check, let alone what the basis was that was or was not reported. When do they report the basis? Oh, okay. Well, the IRS receives basis information from a brokerage house at the time the sale occurs. Well, actually, within the filing deadline of the 1099-B. So the sale might occur sometime in 2011, and the 1099-B is filed with the IRS sometime March or April of 2012. That's when the IRS is informed of the cost. If there's no cost reported on the schedule on the 1099-B, then the IRS does not know what the cost is, and that's what the problem's been. If the IRS doesn't know what the cost is, it assumes no cost. If it assumes no cost, it's the taxpayer's responsibility to determine the cost, and lots of taxpayers are not terribly good about that. So over time, brokerage houses have gotten increasingly good at tracking cost and reporting it, but I still frequently see brokerage statements that have no cost on them at all. And even with the reporting requirement coming into play for 2011, I saw basis not being reported where I knew it should, and I saw incorrect basis being reported. So the fact that basis is on there does not mean that our job just got easier. Our job is maybe even harder because now we know that there's a number there. We have to determine that the number reported is the correct number. Now, are we really going to research every single number when there's 10,000 trades that our client just had during the year? Literally, I had one like that this year. No, heck, I am not going to check every single trade, but there are certain types of trades where I do check, and those have to do with when the sale is the result of selling stock options, restricted stock units, or ESPPs, employee stock purchase plans. Then I do spend a great deal of time analyzing it to see if the profit is being reported correctly, because I've seen it reported incorrectly already this year. But when it comes to the brokerage houses on buys and sells on stock, am I going to analyze that? Absolutely not. We're going to go with it, and as tax preparers, we are actually allowed to go with that. We are not required to audit it. We can assume it's correct. Now, if it's incorrect, it's obviously the taxpayer's problem and the brokerage house's problem and not ours. But our job as tax preparers is to match a tax return to that 1099-B. And we either match it saying the 1099-B is correct and we're going to report according to that 1099-B, or we match the tax return to the 1099-B and explain why the 1099-B is off. Is actually the 8849, or the 8949 rather, is specifically designed for us to explain to the IRS why the 1099-B is wrong. Would you like to know how to do that? Okay, so we'll be getting into that. Now, in general, on the Form 8949, the IRS wants you to report every single trade. This is not a new rule. It has historically been the case you're supposed to report all of the trades. Lots of people are lazy and don't do that. And sometimes the number of trades is so large, it's not physically possible. I did mention I had a client with about 10,000 trades, and he habitually comes in on April 14, you know. But this year something unusual happened. He came in on like the 7th of April. I was in shock. And he had the usual printout of the front page of his 1099-B with none of the accompanying transactions under it. And I said to him, well, we've got time this year, plus the IRS is scrutinizing this more carefully. I need you to send me or email me a spreadsheet of all your trades. Because if you go into any of the brokerage accounts, say it's Smith Barney or Ameritrade or any of the places that people trade, you can do exports to Excel from those, showing all the buys and sells for the year. And I can then take those and use my Excel software to manipulate those and format them correctly that I can import them into my software. It's still very time consuming because it takes a certain amount of time to manipulate everything to get it formatted correctly. Then you have to import it. And typically the first time I do an import, I missed something and it's all screwed up. So then I have to delete it and start over. But eventually I do get to a point where my import is an exact match to the 1099-B, transaction per transaction. But because the software will round up or down to the nearest dollar, there's usually going to be even a difference at the end due to rounding. Could be a $100 difference on 10,000 trades just because you're rounding up or down for every single trade. And it's always going to be rounding up or down to the nearest dollar, and eventually you get off. So you can do a reconciliation entry at the end to make it balance, or you can just let it be $100 off. It's kind of okay either way. If you're a perfectionist, you might do a reconciling entry, and if you're a perfectionist, you might not do a reconciling entry because IRS instructions tell you to round up or down to the nearest dollar. So either way, you've done what you think is correct. Yeah, there's a comment in the classroom. You actually do it in a spreadsheet. Why don't you log in with TurboTax? Well, the thing is, I don't use TurboTax. Yeah, well, here's the deal. It isn't Drake that's not, that we use Drake software, and it isn't Drake who's deciding not to make a function that works with TurboTax. It's just that the brokerage houses have decided to accommodate TurboTax into their systems. The brokerage houses have not decided to go out there and accommodate any of the other many software companies out there. So, you know, there's Lacert, there's AccuTax. I mean, you could start rambling off all kinds of different tax software companies, and only one of them is TurboTax, and only a few professionals even use TurboTax. It's one of those smaller used or less used softwares out there. So really, the brokerage houses are catering to people who are doing their own returns, buying TurboTax off the shelf, and building in these import functions. And the first year I saw they had TurboTax, but they didn't have Excel, I had a tantrum. So most of them have now introduced Excel. And then all our software companies, whoever we use, just needs to do something that can accommodate Excel and then import it. Okay, so you are supposed to report every single transaction, and every single transaction has to be identified on the 8949 as either being reported to IRS with cost basis, reported to IRS without cost basis, and then we have to identify that if it was reported with cost basis, whether that cost basis is correct. And if it's incorrect on a transaction by transaction basis, we have to explain the incorrect amount and adjust up or down for it. How many of you did that this past tax season? Did a little bit of it. All right, now it is possible that you just can't be bothered trying to get all of that imported into your software because it's too much work, and you would just like to mail your client's statement to the IRS. Can you do that? Yes, you can. The IRS has a system in place to allow for that. So if you just want to go with the total year amounts, the buys and sell for the year as a total amount, short-term, long-term, for the appropriate box on your 8949, you can then say see attached statement and attach the paper documents to Form 8453 and mail the forms to the IRS. There's actually a system in place for that. All right. 8949 has columns, and each column serves a function. Column A is where you write a description of the property. Column B is where you enter a code. The exception code is used to say, hey, the cost basis reported to the IRS is different than the real cost. Or the sales proceeds reported to the IRS is different than the real sales proceeds. I'm going to explain the difference by the code I put in here. So there are a number of codes, 3 of which I used regularly throughout the season, the most common of which was code B. I spent lots of time putting code B in column B. Column C is the date acquired. The only thing special about the date acquired is that if you inherited the property, they don't want you to put the date acquired. They want you to type the word inherit or inherited in that space. Column D is the date sold. Column E is the sales price. Column F is the cost or other basis, and column G is adjustments to gain or loss. Now here we have an illustration of when you would use a code, for example. Because if you have a number in column G, you have a number in column G because there's a difference between what was reported to the IRS as cost basis or gross proceeds and what you say is the case. And the IRS wants, when cost basis has been reported on 1099-B, for your column for gross sales price and your column for cost to match the 1099 document. They want you to report the same numbers on the 1099 even though they're wrong. Okay? Then what they want you to do is to say that they're wrong by entering a code in column B and then in column G saying how much it's wrong by. Okay, to make your adjustment there. So here is the explanation. Enter in column G any necessary adjustments to gain or loss. Enter negative amounts in parentheses. Also enter a code in column B to explain the adjustment. Include in this column any expense of sales such as broker's fees, commissions, state and local transfer taxes, and option premiums unless you reported the net sales price in column E. If you entered more than one code in column B on the same line, enter net adjustment in column G. For example, if one adjustment is $5,000 and another is $1,000, enter the difference, which is $4,000. Now here is a table of the explanation codes, and the first one in line is the one I said I hit the most often. It's code B. If you receive a Form 1099-B and the basis shown in box 3 is incorrect, enter a B. And then the next one is home. If you sold or exchanged your main home at a gain, you must report the sale or exchange on Form 8949 and then exclude some or all of the gain, and the code you would enter is H. If you have a non-deductible loss from a wash sale, enter a W. And there's lots of other codes there, but those are the ones I wanted to point out because those are the ones I've seen. Schedule D, capital gains and losses. Schedule D is significantly changed for 2011. Many transactions that in previous years would have been reported on Schedule D must now be reported on 8949. Complete Form 8949 before you complete lines 1, 2, 3, 8, 9, or 10 of Schedule D. You use Form 8949 to report the sale or exchange of a capital asset that is not already reported on another form or schedule. You use it to report gains from involuntary conversions other than from a casualty or theft of capital assets that are not held for business or profit and for non-business bad debts. You use Schedule D to figure the overall gain or loss from transactions reported on Form 8949, to report a gain on Form 2439 or 6252 Part 1 of Form 4797, or to report a gain or loss from 4684, 6781, or 8824, and to report gain or loss flowing through to you from a partnership, S corporation, trust, or estate in which you are an owner or beneficiary, and to report capital gain distributions not reported directly on Form 1040, line 13, or effectively connected to a capital gain distribution not directly reported on that line, and also to report a capital loss carryover from 2010 to 11. So Schedule D and 8949 go together, but you can have D without 8949. It's just you couldn't have 8949 without the D. And here is the revised Schedule D for the year. You can see it's got Part 1 and Part 2, as it always has had. Part 1 being for short-term sales, Part 2 being for long-term. And the instructions tell you before you make an entry in Part 1 to complete Form 8949, and before you make an entry in Part 2 to complete 8949. But that's only if you're making an entry on line 1, 2, or 3, or 8, 9, or 10. If you're just entering a carryover from the earlier year, or you're entering numbers carrying from other forms that go on lines 4, 5, or 6, you go ahead and enter those without attaching 8949. And the same thing goes down to the long-term side. So for example, if you have a long-term gain carrying over from form 4797, you would carry that gain directly to line 11. You wouldn't fill out 8949 as well. And then if you have a loss or a gain coming from a partnership, S corporation, trust, or estate, you enter that on line 12. Capital gain distributions go on line 13. And if you have a carryover loss from the prior year, you enter that on line 14. The next part of our assignment, or our lecture, which is a comprehensive illustration. I created this illustration as a part of the update class that I taught in January of this year, just to try and make sense of everything that the IRS was giving us so that I could understand it and teach it to my staff, as well as obviously all of the tax professionals who wanted to learn about it as well. So this comprehensive illustration incorporates a bunch of things that the IRS changed in tax law, but also which the IRS is focusing on. And the forms that are included in the illustration are Form 1040, 1040A, a Schedule B, a Schedule D, an 8930, it should be 8938, and 8949, and Form TDF 90-22.1, also known as the F-bar report. Our character is named Jake Edwards. He is married to Mary. She is a homemaker. He has a job. Jake is an engineer at Intel Chip Company, and during the year he sold non-qualified stock options. The sale of the options was reported through UBS Financial Services. Jake's UBS Form 1099-B, UBS Intel Advice of Exercise, and his W-2 are all attached. Jake inherited stock from his father, who was a resident of the United Kingdom. His stock remains invested in Barclays of London. The year-end value of the account was £100,000, and the maximum value of the account during the year was £125,000. The US dollar UK pound sterling exchange rate for the year is 64.10, which means it takes 0.6410 pounds sterling to buy 1 US dollar. When you convert that out, it means that the high value of the account, being 125,000 pounds, converts to 195,000 US dollars. And 6,000 pounds in qualified dividends converts to 9,630 US dollars. He did not sell any of his shares in Barclays of London during the year. Jake also maintains a savings account with UK National Bank. The year-end balance and highest balance of the account was $15,000 for the year. Jake paid $100 of US foreign tax to the United Kingdom on his interest income. Mary received a 1099 INT from US Bank reporting $1,500 of Box 1 ordinary interest income for the year. The Edwards sold stock and property during the year in the following transactions. They sold some stock holdings through Smith Barney and Sterling, two different brokerage houses. All the sales are reported on Form 1099-B as shown later. They sold Intel stock options acquired by Jake through an employee stock option plan. An advice of sale exercise notice issued by Intel is included along with a substitute 1099-B statement from USB. They also sold some vacant land that was purchased in 1997, and the land has an adjusted basis of $20,000. It's sold for $100,000. The Edwards have long-term capital loss carryover of $5,000 from 2010. And in addition to what we're dealing with already on the stock sales, two of their stocks had splits over the years. Kroger had a 2-for-1 split in 2010, and Nike had a 2-for-1 split on 8/9 of 11. Never mind if they really did in the real world or not. In my problem, they did. All right, so we have an itemized listing of the Smith Barney account activity for Jake Edwards during the year, and you can see that there were 3 sales. He had a bunch of purchases that we've got records of over time. What we're interested in is matching purchases with stocks that were actually sold. And I'll leave you to muddle through those. I'm not going to explain how to calculate the amounts to you. You can read through those on your own in your own time. But we're going to take these transactions now and translate them to 1099-Bs. Now, of course, there is no way Smith Barney would issue a 1099-B that looks like this, but I wanted to fill the forms out so that you could see how information should be reported for each sale if the brokerage house is doing it correctly. And on this first sale, we have 60 shares of Kroger that were sold. The basis is reported on the Form 1099, pardon me, the sale is reported on the Form 1099-B, however, basis and date of acquisition are not checked because box 6 is checked. So this means that it's going to get reported on 8949 with box what checked? Box B checked, thank you. Now there was a 2-for-1 split on 12-1 of 10, which reduced the cost per share to $12 and increased the number of shares owned to 120. Thus, the cost basis of the 60 shares he sold is 12 times $60 plus $10, or $730. That would be $10 is half the brokerage fee he paid when he bought. We're reporting that on Form 8949 in Part 2 with box B checked because it's long-term. Then we have Smith-Barney with a transaction that has cost basis being reported on 1099-B. Cost basis reported on 1099-B means it carries to what part of 8949? Box A will be checked, and we've got the buy and the sell date both reported on here. They're in the same year, so this is going to be short term. So it's going to go in Part 1 of 8949 with box A checked, and you can see it's indicating that it is short term here. Then we have another 1099-B also out of Smith-Barney. This one has got no date of acquisition, no cost basis. It's showing sales amount of $2,590. Box B is checked. We're going to report this sale on Form 8949 Part 2 with box B checked. Edwards have records that show 50 shares were purchased back in 2009 at a cost of $2,520 plus a brokerage fee of $20 was paid. So their cost basis will be $2,540. On the next 1099-B, we have a date of sale, we have date of acquisition blank, we have cost blank because box 6 is checked. Means it's a non-covered security. 50 Nike shares were sold. The date is reported on Form 1099-B, but basis is not shown. The Edwards records show 25 shares were purchased for $1,770 at a rate of 70 times 25 shares plus a broker fee of $20. But there was a 2-for-1 split on 8-9 of 11, which doubled the number of shares owned to 50, and then 50 shares were sold. So ultimately, they sold all the shares they bought, even though they originally bought 25 and sold 50. The cost in the 50 is the same as the cost in the original 25. Sterling Investments, we're on to a different brokerage house. Sterling's a little bit confused. They have reported the date of acquisition and cost basis for this stock, even though it's a non-covered type of security purchased way back in 2001. So they've reported cost, but the cost is wrong. Why is the cost wrong? Well, the Edwards inherited the stock, and on the date of death, the basis was $4,000, and there's this $3,000 in here, so it's just wrong. So that tells us that we've got a 1099-B with basis reported, but the basis is wrong. What part of Form 8949 do we report this in? Well, it would be Part 2, and then what box do we check? Box, it's going to be A. When cost is reported to the IRS, we check box A. And then we're going to explain why the box has the wrong information in it by entering a code in column B and the difference in column G. So let's take a look at this closely. Sterling Investments has issued Form 1099-B showing a sale of 100 NM shares. Box 6 is not checked and basis is reported. The basis is reported as being $3,000. However, the Edwards inherited the stock, which has a date of death basis of $4,000, or a fair market value on the date of death of $4,000. So we are going to report this sale in Part 2 as a long-term sale with box H checked. We are then going to enter a $1,000 adjustment for the difference in basis in column G. It'll be a negative adjustment, meaning the gain is less than they say. So we sell for 5. They've entered a cost of 3, meaning they're reporting a profit to IRS of 2,000. But the actual profit is 1,000, not 2,000, meaning the profit is $1,000 less than is being reported. That's why we're going to enter negative 1,000 in column G. All right, now we're getting a UBS statement that actually looks like the type of 1099-Bs we're used to seeing. This is a substitute 1099-B, and these are the numbers that are on it. We've got gross sales amount of $13,150, and we have cost on line 3 of $13,120.65. We go across the bottom, and it has the date of sale in box 1A. On box 1B, it has a date of acquisition. You can see it's short-term. In fact, it's so short-term, it's the same day. And that's normal and customary when you're dealing with non-qualified stock options, which is what this is. The sales proceeds are $13,115. The cost basis is higher than the sales proceeds. We would expect to see that on stock options because usually the brokerage commission comes out, resulting in a loss. Jake exercised and sold a non-qualified stock option in a cashless same-day sale. The net income of $3,621 from the sale was properly reported in box 12 of his W-2 with a code V. The exercise was also reported on Form 3921, which is issued by the payer or his employer to the IRS, reporting that a non-qualified or that stock options were exercised. The sale is reported on Form 1099-B with basis shown. Because of brokerage fees relating to the sale, the cost basis is higher than the sales proceeds. So let's take a look at a couple of the documents I've inserted in the manual for you. One of them is Jake Edwards' W-2. You can see he's got wages on box 1 of $128,621. Down here on line 12B, there's a code V. Code V on a W-2 means that there was an exercise of non-qualified stock options and that the difference between what that employee had to pay for those options and the fair market value of those options on the date of the exercise has to be grossed up into their wages and included on their payroll. So his payroll in box 1 and 3 and 5 has been grossed up as a result of these options to that amount of money. Then we have a 3921, which is just telling the IRS that the options were exercised, the exercise price, the fair market value, and the number of shares exercised. Well, if you take $26.24.2413, subtract 19, and multiply that by 500, you should get a number something similar to this. That's where that number comes from, because the difference has to be included in income as wages. Moving on to the advice of exercise, this is a document that is a direct copy of what I see my clients bring in who work for Intel. Intel is a marvelously sophisticated company with a wonderful system of reporting in place that makes my job as a tax preparer very precise. Not all large employers are nearly as good, but in the dream world, a tax preparer will have a client bring in documents like these that we can use to button everything down and know that we have perfection on our tax return. In a less perfect world, our clients have nothing like this, and we're left scratching our heads and trying to figure it out. So let's take a look at what we've got here coming in for the advice of exercise. This is what this is called. This document was issued at the time Jake exercised his stock options. It shows the sales price, which was the fair market value, and the sales proceeds. It also shows the option price that he paid, which is $19. 19 times 500 gives us $9,500. So he paid $9,500 for the shares that at the time had a fair market value of $13,120.65. The difference is the $3,620.65. That's the amount that was grossed up on his W-2 and reported in box 12 with a code V. So those are matching up perfectly like they should. So what is Jake's cost basis in these stocks? His cost basis is the amount that he paid plus the amount that's been grossed up onto his W-2. His cost is therefore $13,121. So that's what we're looking to see reported on the 1099-B, and is that what happened? Let's go up and take a look. We've got the $13,121. It's perfect. Why have they given him less than that when he sold? Because they kept their brokerage fee. That's why he has a loss. Jake Edwards. This is his 1040 form. We have line 7 showing his wage income from his W-2 of $128,621. Then on line 8A, we have $2,000 of interest. I've got a Schedule B following that shows you where those two numbers came from, but off the top of my head, $1,500 was payable to Mary on a 1099 INT, and the other $500 came from a bank account that Jake has in England. Then we have $9,630 of dividend income. That all came off of his Barclays account after accounting for U.S. currency exchange rates with the British pound. Then on line 13, we have net gains from all of those stock trades, one of the exchanges is actually the sale of land. So we're going to have to take a look at where the $77,999 came from. And then on line 22, we have $218,250. We decided to give these people a deduction of $11,620, a personal exemption amount of $7,400, and we're ending up with taxable income of $43,000, or on line 43 of $199,230. So obviously we're going to have to fill out some capital gain worksheets to figure out the rate of tax or the amount of tax that Jake Edwards is going to owe on that. He's eligible for a foreign tax credit of $100. We've entered that on the line. And let's move on to his Schedule A. His Schedule A, they're itemizing for only because they had income taxes withheld on the W-2 that are more than the standard deduction. I didn't give you any other reason to itemize them. On Schedule B, we have the U.S. National Bank, we have the U.K. National Bank and U.S. Bank, total interest of $2,000. The Barclays dividend income of $9,630. Now at the bottom of this, I've circled an area in yellow. This area has a series of questions in it that you are supposed to answer. The first question says, at any time during 2011, did you have a financial interest in or a signature authority over a financial account, such as a bank account, securities account, or brokerage account located in a foreign country? The answer is yes, he does. Question number B. If you are required to file Form TDF90-221, enter the name of the foreign country where the financial account is located. And the answer is yes, he is required to file that form. That's why we're preparing it. And we're checking, yes, he's required, and the country is the United Kingdom. And then during 2011, did you receive a distribution from, or were you the guarantor of, or transfer to a foreign trust? No, he's not, so we've checked that box. Here is his Schedule D, and of course you can't do the Schedule D until you've done the 8949. And based on what I'm seeing here, how many 8949s does he have to do? A few. Yeah. He's going to have to do 5 different 8949s. He has to do an 8949 Part 1 with Box A checked, an 8949 Part 1 with Box B checked. He has to do an 8949 Part 2 with Box A checked on line 8. He has to do an 8949 with Part 2 Box B checked, and he has to do an 8949 Part 2 with Box C checked. When he does all of that, he's going to carry these numbers over and enter them in the column shown on the Schedule D. So let's take a look at each of these 8949s. The first 8949 has Part 1, Box A checked. We have 2 different transactions reported in that part. Both cases we see here, we have a sales price, a cost or other basis being reported, and we have the 50 shares of Intel. Basis reported to IRS. Yes, so these are correct, and we're not disagreeing with any of those allotments, so there's no adjustment going on. Then we move on to the next sale, which was 100 shares of NM. Yes, the date acquired is inherited. Cost basis was reported, so we check box A, and we enter the amount of cost basis that was reported to the IRS, and then we say it's wrong, and enter the correction in column G. Moving on to the next 8949, we have Part 1, Box B checked, 50 shares of Nike. Since no basis reporting is going on to the IRS, the instructions for 8949 say to enter the actual cost in column F. So whatever it is that was not reported is okay, because the 1099-B did not report to anything to IRS. We're not trying to reconcile to a 1099-B on cost. We're simply going to enter the actual cost with no adjustment in this column. Then we go on to Part 2 of Form 8949 with Box B checked. We enter the 2 stock sales that were long-term with no cost basis reporting to the IRS. We show the sales price that was reported to IRS, and we show the cost that was not reported to IRS. So all of those 8949s transfer over to the Schedule D. And the last one that we filled out is 8949 Part 2 for the long-term sale of the land. The land was not reported on a 1099-B, so we check box C. We enter the sales price and the cost. All right. Now, we had to do a qualified dividend and capital gain worksheet for the Edwards because they had capital gains. They also had qualified dividends. I spent a little bit of time explaining this worksheet in detail earlier in the class, so I'm not going to do it here. Save to say that line 1 is the taxable income from the 1040. We're pulling out the portion of line 1 that is qualified dividends. Then a little bit later on, we pull out the portion that is other capital gains. We go about figuring the rate of tax owed on capital gains at 15%. We then look up the tax in the tax rate charts, actually, for the balance of the income, add the capital gain tax to the tax owed on his other income. When we're all finished, we end up with $33,335 that carries to line 44 of the 1040 form. Now that's the summary of the preparation of the return itself, but we have 2 other documents to prepare for the Edwards, one of which is the FBAR report, and the other is a brand new form introduced for tax year 2011 and future years, and that's Form 8938, Statement of Specified Foreign Financial Accounts. So we're just going to talk about that form for a few minutes, and then we'll move on to see the illustration of it. For tax years after March 18, 2010, the IRS is requiring individuals to report certain foreign financial assets if the value of those assets exceeds $50,000. A new form, Form 8938, Statement of Specified Foreign Financial Assets, is required to be filed in the following situations. Number 1, you are a specified individual. So who is a specified individual? Well, a specified individual is someone who is a U.S. citizen or is a resident alien for any part of the year, or who is a non-resident alien and has made an election to be treated as a resident alien, or a non-resident alien who is a bona fide resident of American Samoa or Puerto Rico. And you have an interest in a specified foreign financial asset that is required to be reported. A specified financial asset or foreign financial asset is a financial account maintained by a foreign financial institution. Other foreign financial assets held for investment that are not in an account that is maintained by a U.S. or foreign financial institution, such as stocks or securities issued by someone other than a U.S. person, any interest in a foreign entity, and any financial instrument or contract that has an issuer or counterparty that is not a U.S. person. And the final test, the aggregate fair market value of your specified foreign financial assets is more than the reporting requirement thresholds that apply to you. So essentially, the bottom line is the form is required if you're a U.S. person and you have foreign financial assets. And the foreign financial assets trigger a requirement for 8938 when your balance in those accounts goes over the threshold amount. The valuation in those accounts is high enough. If you are a taxpayer living in the United States and you are not married, the form is required if you have $50,000 or more in that account on the last day of the year. If you are unmarried and on the last day of the year you have less than 50, but at any point during the year you had 75,000 in the account, the form is required. Now, if you are living abroad, those balances are significantly higher. If you are married filing jointly and you reside in the United States, then the threshold amount is $100,000 on the last day of the year or $150,000 at any time during the year. And if you are married filing separate, it's the same as for single. So, does Jake Edwards meet those thresholds? He does, because his highest balance during the year was $178,000. So he's required to file the form. So here is the form that we filled out for him. And the form is essentially, it's quite snoopy, so is the FBAR reform. The form wants to know who the form is being filed for. It does allow for a joint filing. It wants to know the type of account you had. It wants to know the maximum value in that account at any point during the year, in this case $195,008. It wants to know the foreign currency in which the account is maintained, and we say pound sterling, and the foreign currency exchange rate used to convert to US dollars 0.6410. And then in box 3, it says source of exchange rate used if not from the U.S. Treasury Financial Management Service. There's actually a link. If you were to go to irs.gov and just in the internal search box within irs.gov, type exchange rate and then just follow the links that come up, it will take you to this currency exchange rate converter. And so if that's what you use, you don't need to put anything in box 3. But if you used another method for currency exchange, then you need to tell them what currency exchange you used. The name of the financial institution in which the account is maintained, the address of the financial institution, and then we move on to the next page where they actually want us to describe where on the tax return we reported income that correlates to the money we have overseas. So in the case of the Edwards, we have $500 of interest income generated overseas, and that's been reported on Form 1040 on line 8A, and the schedule we attached was Schedule B. Line 1 is where we reported the interest income. For the dividend income, the amount that was reported on the former schedule is $9,630. We reported on that in Form 1040 line 9A and on Schedule B line 5. And then we move on to the FBAR report. Jake Edwards is the only holder of this. With the FBAR reports, you actually have to file a separate report for each filer. So if Jake and Edwards had joint accounts overseas, each of them separately would have to file the same FBAR report, even if the FBAR report was reporting the exact same money. So the report itself is not a tax return. It's not reporting income. It's merely reporting that I have control over a bank account or I have access to the money in a bank account overseas, and I have to tell you the information. And the FBAR report is even snoopier. It actually gets into account numbers. It wants to know what the account number you have overseas is. And on an account-by-account basis, it wants you to identify the address, the account number, and so forth, and the amount that was held in that account during the year.
Password number 2 is nuthatch. N-U-T-H-A-T-C-H. Nuthatch.
All right, selling a business. The sale of a business is not usually the sale of a single asset. Instead, all the assets of the business are sold, and generally when this occurs, each asset is treated as being sold separately for determining the treatment of gain or loss. A business usually has many assets, and when sold, these assets are classified either as capital assets, real property used in a trade or business, or property held for sale to customers. There can be other kinds of assets as well, but for simplicity in the case of our class discussion today, we're going to look at the typical things that would trade hands in a buy-sell agreement between the seller of a business and a buyer of a business. And typically what will be sold when you sell a business are certain intangible assets like going concern value, goodwill. You're going to have fixed assets like furniture, equipment, and you're going to have real assets like real estate. And then the final asset you're going to have would be inventory if you sold a business that had inventory. So those are the key types of things that we see go on. When a business is sold, both the buyer and the seller have to file Form 8594, Asset Acquisition Statement. Now, I have dealt with clients who have attorneys involved in the transaction. The attorneys actually fill the 8594 out for each party in the transaction, and each party in the transaction brings us the completed 8594. I have seen it even more often where no one has a clue about the 8594, and we're having to do it for them. And I've also had, as I described in my class on Tuesday, situations where there isn't even a breakdown of the sales price between the assets, and we're having to do that as we're working on their tax return to figure out what the valuations on those should be. Now, if you are selling your business, you may be required to file one or all of the following forms: 4797, 8824, 6252, and Schedule B. For sure, it's probably going to be 4797, 8824, and Schedule G. Probably be all of those. So let's look at the 8594. The first time I ever had to fill out an 8594, it was like, what the heck is a Class 1 asset? What's a Class 2 asset? What's a Class 3 asset? But fortunately, there is something called the instructions, and back in those days I used Package X. These days all you have to do is go to the IRS website, or you can do a right click on your computer to see if the help function tells you. I think my help key helps me on my computer if I can't quite recall. Class 1 assets are cash and general deposit accounts, including money in the bank. Cash 2 includes U.S. government securities and publicly traded stock. Class 3 are assets that the taxpayer marks to market for at least annually for federal tax purposes, none of which you're typically going to deal with in most sales of businesses. So classes 1 through 3 are usually left blank. When we get down to Class 4, we're dealing with something that's more likely to have a number in it. Class 4 assets are stock in trade of the taxpayer or other property of a kind that would be included in inventory. So if you purchased a business that included inventory, that inventory would be a Class 4 asset and is entered on this line. Class 5 assets are pretty much everything else that you might purchase with that business. It includes things like office building, photocopier, phone system, computer. And we have a listing of a sale of a business that has assets of that type reported on it, and it's a little bit later, beginning on page 63 of this manual, and right now we're on page 58, so we're getting close. Class 6 and 7 assets are the intangibles. Class 6 assets are Section 197 intangibles as defined in Section 197 with the exception of goodwill and going concern value. And Class 7 assets are the goodwill and going concern value. So you can see on this particular form, we've entered the Class 5, 6, and 7 assets, totaled them up at the bottom. There's a question that says, did the purchaser and seller provide for an allocation of the sales price in the sales contract? For simplicity, I said yes, but as often as not in real life, I've had to check no. So reporting Section 1231 gains and losses. Section 1231 gains are reported on Form 4797, Parts 1 and 3. A net gain is carried to Schedule D and reported as a long-term capital gain on Form 1040, line 13. And a net loss is carried to Part 2 of Form 4797 and is claimed as an ordinary loss on 1040, line 14. So here is Form 4797. We're going to be looking at it section by section. And Part 1 of Form 4797 is used to report the sale, exchange, or condemnation of Section 1231 property held for more than 1 year for which recapture or recovery of depreciation is not required. So if we are recovering or recapturing depreciation on the sale of an asset, would we report that asset in Part 1? That is a giveaway, no. No, we would not. If we have a profit on the sale and any part of that profit is due to recapture or recovery of depreciation, it does not go in Part 1. It goes somewhere else on the form, but not here. Examples of asset sales or dispositions that you would report in Part 1 include the sale of an office equipment used in a trade or business and held long term. Depreciation is not being recaptured because the asset is being disposed of for an amount equal to or less than its adjusted basis. Let's just suppose I've purchased a photocopier for $8,000, nice big fancy photocopier, $8 grand. And I didn't Section 179 it, I didn't claim bonus depreciation on it, I've just been going straight line on it. And after 3 years I traded in and I've claimed, I'm just going to pull a number out of my head, maybe $3,000 of depreciation on this $8,000 copier. And when I sell it for $4,000. I paid $8, I've claimed $3 of depreciation, I sell it for $4, I'm selling it at a loss. It would go in Part 1. But if I sell that same photocopier for $7,000, I pay $8, I claim $3 of depreciation, that gives me an adjusted basis of $5. If I turn around and sell it for $7,000, I actually have a gain. The gain is due to recaptured depreciation. It would not go in Part 1. It would go in Part 3. in that situation. You also use Part 1 to report the sale of real estate used in a trade or business and held long-term. Depreciation is not being recovered because the asset is disposed of for an amount equal to or less than the adjusted basis. So if you sold a commercial office building that you purchased and you claim depreciation on it, and then you sell it and you sell it at a loss even after factoring for depreciation, then it would go in Part 1. But if you sold that commercial office building at a profit, and part of that profit is due to recovery of depreciation, it would go in Part 3. And then finally, the last thing that specifically goes in Part 1, and this is according to IRS instructions for Part 1, you report the sale of land there. Because land is non-depreciable, you'll never have a recover or recapture of depreciation on the land, will you? 4797, Part 2. Part 2 is kind of a funny section. You use Part 2 to report ordinary income from the sale of business assets not reportable in Parts 1 or 3. Asset dispositions reported in Part 2 are generally assets which have been held short-term. However, Section 1244 losses are reported in Part 2 even if they are long-term. Examples of asset sales or dispositions to be reported in Part 2 include the sale of office equipment used in a trade or business and held short-term, the sale of real estate used in a trade or business and held short-term, ordinary gains or losses from the sale of publicly traded partnership units. What's that got to do with a business? We'll get to that later at the end of the class today. And then Section 1244 losses from the sale of small business stock. Now this is an odd one because earlier in the day, remember we talked about that Section 1202 gain, that if you sell small business stock at a gain and it meets the particular parameters, you'll be able to exclude half to 100% of your gain. Well, the flip side to that is that you could sell a similar type of business, but actually you've lost your shirt on it. Rather than making money, you lost a bunch of money. And then if it meets the parameters for that particular kind of treatment under Section 1244, you're allowed to claim a much larger loss than is normally the case under the capital loss rules. And remember I said that line 13 of 1040 can never have more than negative $3,000 on it. But if you sell a qualifying stock under Section 1244 at a loss, you can claim a loss of up to $50,000 on Form 4797 in Part 2 and carry that $50,000 loss over to line 14 of the 1040 and realize a much larger loss at one time in the year of that disposition. And you can double that number for married filing joints. Any loss above and beyond that that is a 1244 loss would continue to be claimed on Schedule D subject to the $3,000 carry forward amount. Now we're on to 4797 Part 3. You use Part 3 to calculate recapture and recovery of depreciation or amortization on assets used in a trade or business and held long-term. Gain on the disposition of an asset that is a recapture of depreciation is taxed as ordinary income, and gain on the sale that is a result of increased value or appreciation is taxed as capital gain income. Now, Part 3 is a really long section, and we've got this stuff here for Section 1250 property, 1252 property, 1254 property, 1255 property. All of these sections in here, I've never filled those out. They have to do with very rare situations, most of which have to do with pre-1981 assets that are, we're not going to be dealing with those. I don't teach them in the class today. They aren't anything that you'll normally deal with. Instead, what we do deal with on a regular basis, and what I will include in this class, is line 19 through 25. And 26, even when we're selling Section 1250 property, typically line 26 is not what we're filling out. We're reporting that up on line 19 through 25. And real property is not on line 25, only through line 24. So we're going to do an illustration in a minute to show you how to fill this form out. The final piece to tell you about Part 3 and when it is required. Examples of asset sales or dispositions to be reported in Part 3 include sale of a car used in a trade or business where the sales price is greater than the adjusted basis and depreciation has previously been claimed on the vehicle. So you sell it at a profit and you claim depreciation. That triggers Part 3 of the form. Sale of a franchise for a profit where amortization has been claimed against the original purchase price. Sell it for a profit, amortization was claimed. You're going to put it out in Part 3 of the form. Sale of real estate for a profit where depreciation has previously been claimed also goes in Part 3. The final part we're going to look at is Part 4 of Form 4797. It's kind of an afterthought at the very bottom of page 2. Property that you report in Part 4 is property that is subject to a recapture of depreciation. A recapture happens when a Section 179 deduction has previously been claimed and then the percentage of business use drops to 50% or less. Or you have listed property where you claimed accelerated depreciation, even double declining balance under makers. You claimed accelerated depreciation on listed property and then your business use percentage drops to 50% or less, you have to do a recapture. And the deal with Form 4797 is that whether you have a gain or a loss on Form 4797, that gain or loss carries to the 1040 form. A gain that is due to recapture of depreciation goes on line 14. A gain that is due to a capital gain goes on line 13. And any loss from the 4797 will always carry forward to line 14 of the 1040. But if the income from 4797 is due to a recapture, the recapture carries to the income form on which the deduction was originally claimed. So if you're filing self-employment and you claim a Section 179 deduction for a computer, and then that business use of that computer drops to less than 50% or 50% or less, you're going to have a recapture. And that recapture does not carry to line 14 of the 1040. It will go right back on the Schedule C where the deduction was originally claimed. So we have an example here of how that would work. In 2010, Max purchased and placed a computer and service in his business at a cost of $2,000. He claimed a Section 179 deduction for the full purchase price on his 2010 Schedule C. Then in 2011, Max's business use of the computer dropped from 100% to 40%. So the depreciation claimed in 2010 was $2,000. The 2010 depreciation calculated straight line would only have been $200, and the difference between those two amounts is the recapture amount, $1,800. So he would fill out Part 4 of Form 4797. He'd report the original Section 179 deduction claimed, the recomputed depreciation he should have claimed, and the recapture amount of $1,800. Now here is a detailed illustration of Form 4797, all filled out for you. During the year you sold the following business use assets, all of which you held long term. Your net income from Schedule C was $38,609. Report your gains and losses from each sale as follows. We have the office building and the date acquired on it, and you can see that all of these assets have the same acquisition date of the 1st of January 2008. They all have the same sales date of June 15, 2011. Over here we have the cost of the office building being $120,000 with a land value in it of $20,000. We have a computer costing $4,000, a copier costing $8,000, a telephone system costing $10,000, and goodwill costing $18,000. Then we have the accumulated depreciation. In the case of goodwill, we have accumulated amortization. And we arrive at our adjusted basis on each of these assets. So our adjusted basis is what we're going to compare to the sales price to determine how much of a gain or a loss we have. And in the case of the adjusted basis on the real estate, we have a sales price that exceeds the cost, and we have a profit on the sale of that real estate that's $38,760. On the computer, we have a loss of $422. On the copier, we have a profit of $157, and that profit is entirely due to recapture of depreciation. On the telephone system, we have a profit of $3,552. That also is due to recapture of depreciation. On the goodwill, we have a profit of $26,200, of which $4,200 is a recapture of depreciation. Now up here on the building, we do have depreciation that was claimed. The depreciation claimed on the building was $8,760. So we have a recovery rate on the unrecaptured gain on that building of $8,760. Total capital gain or loss $30,000, and $8,760 is the unrecaptured gain portion. So this is the gain, $38,760, of which $30,000 is capital gain, and $8,760 is going to be recovery gain at a rate of 25%. So just thinking about the rules in our head, what part of Form 4797 will the sale of the office building go to? Where should we take that? Part 3. And the computer, where would we put that? Part 1, yes. Good work. The copier, what part? Part 3, correct. Goodwill. What part do we put goodwill in? It's a sale of an asset on which depreciation or amortization has been claimed. Where? 3, part 3. Okay, anytime you have an asset on which depreciation or amortization was claimed and there is a profit, and any of that profit is attributable to a recapture or a recovery of depreciation, it's going to go in part 3. It is important to correctly report the sale of the assets on Form 47 correctly, Form 4797 correctly. I've got 2 illustrations in this manual. One illustration shows you how to do it wrong, and the other illustration shows you how to do it right. So let's take a look at how to do it wrong first. And I'm actually going to spend a long time going over how to do it wrong in a great deal of detail. Who can figure out while I'm talking what's missing in part 3 for a start? So in part 3, I've reported the office building, the copier, and the telephone system. And I've reported the sale of the office building at $150,000 with a cost of $120,000, and I've reported depreciation of $8,760, giving me an adjusted basis of $111,240 and a total gain of $38,760. In property or column B, we've got sales price on the copier of $2,000. We have a cost of $8,000, accumulated depreciation of $6,157, and an adjusted basis of $1,843. We sell for $2,000 with an adjusted basis of $1,843. That gives us a profit of $157,000. Let me zoom in a little so it's easier for you all to read. And so 100% of the profit on the sale of this copier is attributable to depreciation. And so we have an entry on line 25 which says, if this is section 1245 property, enter the depreciation that was allowed on the asset, which is $6,157, and then enter the smaller of the depreciation claimed or the profit from the sale. And in this case, the smaller number is the profit from the sale. Then in column C, we've entered the telephone system. The sales price was $7, the cost was $10, the depreciation claimed was $62.52. The adjusted basis is $37.48, and the total profit, which is $7,000 minus our adjusted basis of $37, is $32.52. On line 25, it says enter the depreciation that you've been allowed to claim or did claim, and the smaller of line 24 or 25 in this case is the depreciation claimed again, and that's $32.52. So not the depreciation claimed, but the gain is the smaller number. Now, one of the things I want to point out is that it's important to understand when you're dealing with Section 1245 property and 1250 property, and does your software know that you've sold 1245 property or 1250 property if you don't tell it what you sold? It does not know that an asset is 1250 property unless I go in and tell it I sold 1250 property. That means I, as a tax preparer, need to be able to identify 1250 and separate that from 1245. So the software that we use is Drake software, and when I go in to trigger the sale of an asset, it asks me, did I sell a Section 1250 asset or did I sell a Section 1245 asset? And believe you me, it's not going to put a number on line 25 if I didn't tell it it was 1245 property. So it's pretty important to understand which asset type you are selling so that you trigger that correctly. Now we go down to the bottom of the form, and on line 30 it says, what is the total gains? Adds up all the property in column A through D on line 24. So we add up these totals, $38,760 plus $157 plus $32.52. When we total those up, we get $42,169. Then on line 31, we total up the amounts entered on line 25. That's $157, $32.52, and that comes out, and we entered on line 31 of $34.09. We then subtract line 31 from line 30 to get line 32. Line 32 represents the portion of profit that is true capital gain that will get capital gain treatment. And line 31 shows the amount that is ordinary income and will be taxed as ordinary income. Right off the top of your head, thinking about these two numbers, which of these will carry to line 13 of Form 1040 and which will carry to line 14 of 1040? 32 goes where? Line 32 is the capital gain portion. It's going to go to line 13 of 1040. Line 31 is the recapture of depreciation amount, and that's going to go to line 14. But both of these are the wrong number because this illustration is wrong. Has anyone figured out what's missing up here? The goodwill belongs on line D, and, well, I missed it. Let's see why that matters. We're going to move on to part 1. Now, 4797 is one of those forms where you fill out page 2 before you fill out page 1. That's why my illustration starts with page 2. It's one of those forms you fill out backwards. So we're going to go over to page 1 now of the form and fill out part 1. And you can see here we've stuck goodwill in part 1. And the problem with sticking goodwill here is we do show depreciation or amortization being claimed on the goodwill, but what it does is it serves to reduce basis so that when we sell, it just makes the profit in column G bigger. But there's nowhere that it pulls out the portion of that recovery that is for depreciation and adds it to a number that will carry to line 14. Instead, it includes it in a number that ultimately will carry to line 13. So then on line 6, we enter the amount that is capital gain from part 3 of the form. And then we combine these amounts, 422, 26,200, 38,760, and we get 64,538. Then on line 13, we enter the amount of recaptured depreciation. And of course, the amount shown here on line 13 is ultimately going to carry to the Form 1040. This is a cutout of the 1040, and it's going to get entered on line 14. And this amount right here, the 64,538, that is capital gain, ultimately will end up being reported on line 13. And of course, we have to attach a Schedule D. And we're going to have to do some capital gain worksheets and so forth to figure it all out, what the tax will be, which is the next part of this illustration, is to show you the recapture rules and how they work. Now, one of the assets that we're looking at here is a Section 1250 gain worksheet. It's kind of a pointless worksheet. I've never quite understood why we have it there, but it's a worksheet that comes out in the software. It's in the IRS instructions, and so I fill it out for you. But what the worksheet does is it says, look at Schedule D and identify the sale amount on Schedule D or the income amount being reported on Schedule D that is due to recovery of depreciation on Section 1250 property. And whatever that number is on the Schedule D that is for that amount, carry it to a specific line of the Schedule D worksheet for calculating capital gain. And I don't really need a worksheet to tell me what that number is. It's pretty self-evident to me. But here is the capital gain worksheet for figuring capital gain tax for Schedule D. This is a similar worksheet to the one we did earlier, which was the qualified dividend and capital gain worksheet. But the capital gain and qualified dividend worksheet does not provide space for entering Section 1250 gain. So anytime you're dealing with Section 1250 gain, you have to deal with this more complex worksheet. So we begin on line 7. Or actually, we begin on line 1 by entering the taxable income from line 43 of the 1040 form. And then we enter the smaller of line 15 or 16 from Schedule D. That's our capital gains income that's going to be subjected to capital gains rates of tax. And then the form says pull out the portion of that that is due to recovery of depreciation on the sale of that Section 1250 property to arrive at the net number on which you're going to figure your capital gain rate of tax. This net number that we come up with here fairly much exceeds the threshold amount for the filing status of a single person, so none of the gain is going to get taxed at 0%. It's all going to get taxed at 15%, except, of course, we've given this filer enough income that we're pushing them into a bracket. That means that not all of their recovered depreciation on the sale of the commercial building is going to get taxed at ordinary rates. So what I mean by that is if you are in the 25% or lower bracket and you sell Section 1250 property at a gain where there is a recovery of depreciation, you include any recovered depreciation in your income until you hit the threshold point for your filing status, and that would be the point at which you move into a tax bracket that's higher than 25%. And when that happens, the worksheet starts to kick in and work for you. And in this case, we do this weird formula here where we figure the amount of recovered depreciation and what portion of that depreciation has already been included in income that we're looking up tax for on the tax tables, and what portion is going to be held out separately and taxed at a maximum rate of 25%. When we do that, we find that the amount that's going to be separately taxed is $4,051, and the tax on that is $1,013. We then figure the capital gain tax on all of the other capital gain income we have on the return and add that to the tax from the tax tables. So the capital gain tax, we have $55,778 of capital gains. We're multiplying that by 15%, and we get $8,367. We add that to the additional tax owed at the higher rate on the portion of the sale or recapture on the office building that has not already been included in tax being looked up in the tax tables. So we take this number of 8,367, we add in the recovery depreciation portion of 1,013. We then go to the tax tables and look up the tax on all of our other income, and we add all of those numbers together, and we get $14,136, and we enter that on line 44. So that's a very long-winded way to show you how to do it wrong. Let's show you how to do it right. Now in this second illustration here, we've got start again with part 3 of Form 4797. And this time we've put the goodwill in here. And the significant thing about the goodwill is now that recapture of amortization on the goodwill is going to be included in the Section 1245 line. So this line just doubled, didn't it? It's going up by quite a few $1,000s. It's now $7,609. And looking at where that's going to go on the Form 1040, we're going to end up with a number on line 14 that's substantially higher. And we're ending up with a number on line 13 that is clearly lower. The other thing that I did, and I went through it kind of fast, is I got real specific. The instructions for 4797 say that land is always reported in Part 1 and the building sits on land. So should I separate the land out and put it in Part 1? It's probably not necessary. But because I like to be following the instructions exactly because I'm teaching the law, I thought I'd better pull the land out and put it in Part 1. So what I did is I looked at the proration of the price between the building and the land, prorated the cost basis between the building and the land, and used that to figure out what portion of the sales proceeds are for the building. Ultimately, it really doesn't matter because the land's not depreciable. It doesn't affect the net amount on line 22. Whatever I do, the amount on line 22 of Part 3 will stay the same. But if you're feeling super precise and you want to put the land in Part 1 because it is land, and you want to put the building in Part 3 because there's a recovery of depreciation on it, that's perfectly correct. But if you did it the other way like I did in the incorrect illustration, it doesn't change anything. No auditor is going to pitch a cow over it. But this goodwill being reported in the wrong section, that is a problem. So let's go over then to Part 1 of the form, and this time I've got the computer and the land there rather than the computer and goodwill. And we've got the $422 loss on the computer. We have a $5,000 gain on the land. Ultimately, we're pulling over $55,760 of capital gain from Part 3 and adding that to the net gain showing on the front here in Part 1 to get $60,338. Then we have the gain, that is Section 1245 gain, being entered here on line 13 and again on line 17 and 18. Ultimately, that 7609 is going to carry to line 14, and 60,338 is carrying to line 14, or pardon me, line 13. We fill out the same worksheet, all new numbers now. I'll let you study that in its entirety if you really care to. But ultimately, when we're all said and done, after filling out the capital gain worksheet a second time, we end up with net tax of $14,556. That tax is $420 more than the tax we calculated in the first illustration. So it seems like a pretty minor thing to move something from Part 1 or from Part 3 to Part 1, but by moving it from Part 3 to Part 1, we've underreported tax by $420. And of course, the error could be much more severe than that, depending on the amount of income we're dealing with and the tax rate of our filer. All right, reporting the sale of automobiles used in a trade or business. Now, this is something we would run across all the time in what we do. If you sold or otherwise disposed of a vehicle that you used in your trade or business, you need to file Form 4797 regardless of whether you claimed actual expenses with depreciation or you claimed the standard mileage rate. Now, if you claim the standard mileage rate, what you do need to know is that a portion of the mileage rate is for depreciation. And for 2011, that portion of the standard mileage rate that is for depreciation is 22 cents per mile. So that 22 cents per mile that you pound onto your vehicle where you're using it for business use is actually reducing your basis in the vehicle for tax purposes. And over the years, we've saved the standard mileage rates for you, going all the way back to 1999. I taught my first tax class in 2001. We were teaching 2000 tax law. So at that point, I looked up the rates, and I've saved them ever since. So going forward, each year in time, there is slight variations in the standard mileage rate, the portion of which is for depreciation. 2010, it was actually a higher number than it is this year, 2011. So let's look at an illustration of how all of this would work out. In 2009, you purchased a car for use in your business for $20,000. You drove your car 10,000 business miles during 2009, 5,000 business miles in 2010, and 7,000 business miles in 2011. During 2011, you sold your car for $10,000. Total mileage for the car is shown for each year in the following chart. So we have 2009, 10, and 11, and the miles put on the vehicle for each of those years totaled 35,000. So it's total miles put on the car over that 3-year period, 35,000. That would be a pretty normal amount of mileage for an average American driver. And then we've totaled up the business miles that I gave you for each year, and those total 22,000. Well, if you take 22,000 and divide that by 35,000, you have the percentage business use on that vehicle. Then for each of these years, we also have the depreciation rate times the number of miles driven. So we have 21 cents for 2009, 23 for 10, and 22 for 11. We multiply those out by the miles driven each year to come up with the depreciation that was claimed. So the depreciation claimed on the vehicle was $4,790. So looking at this scenario, we have a total purchase price on the car of $20,000, a sales price of $10,000. So we're selling it on the face here for a $10,000 loss, but we're going to have to do a factor in here for the percentage business use, and the percentage business use is going to be 22 divided by 35. So how do we figure that out? Well, when we take 22,000 miles divided by 35,000 miles, we get 62.86%. If we take 62.8% and divide that by, or multiply that out by the purchase price, it means that $12,572 of the purchase price would be considered to be allocable to the business side of the use of the car. And from that business use cost, we're going to subtract out the depreciation that was claimed on the car through the standard mileage rate. When we do that, we get $12,572 minus $4,790 for a net adjusted basis on the business portion of the car of $7,782. The next thing we do is we look at the sales price of the car, and we also multiply that by the business use percentage. So we get sales proceeds from the car of $6,286. That's clearly less than our adjusted basis, which means the vehicle was sold at a loss. And ultimately, that loss is $1,496. We would report that loss on Form 4797 in what part? Part 1. Thank you. The next topic of the day is publicly traded partnerships. And this is something I tortured myself with over the weekend throwing in here, trying to burrow into a complicated topic and narrow it down into a few pages in an illustration that made sense to you. Because here's the deal. I have clients that come in all the time who have K-1s from these publicly traded partnerships, and then they sell stocks on the stock exchange in these publicly traded partnerships, and they get these K-1s from the publicly traded partnerships with these worksheets attached. Have any of you ever noticed that? Would you like to know what you do? Would you like to know what you're supposed to do when you get those worksheets? So anyway, I found this rather puzzling. I wasn't exactly sure what to do, and if I read the instructions for partnerships, I couldn't figure it out. If I read the instructions for Schedule E, I couldn't figure it out. If I read the instructions for passive activity losses, I couldn't figure it out. So finally, I called up the IRS, and I asked for their tax practitioner hotline, and I got a person who didn't know the answer. And so they put me through to another person that didn't know the answer. And finally, they said, well, we have to have one of our specialists call you back. And when they say specialist, it's probably going to be an auditor who is knowledgeable on that topic. So the auditor called me back and said, well, this is what you do. And I said, well, can you show me where it's written that way? Because when I hang up the phone, I want to know my source. And you saying this is what you do isn't good enough. So she said, I'm not exactly sure. I'll have to look that up and call you back. So she did look it up, and she did call me back. And so I've referenced the actual source of what it is you're supposed to do in the manual here. But essentially what goes on when you buy a publicly traded partnership is you become a partner in the partnership. And that partnership will issue you a K-1 each year. And the K-1 will show either a business profit or a business loss. And very often it's a loss. Yeah. Your percentage of ownership will be a teeny tiny little number. And in addition to this loss that is purportedly carrying to you, you're also dealing with these distributions that are occurring. And what does all of that add up to? So the first thing to tell you is that when you buy units in a PTP, or publicly traded partnership, you become a limited partner in that partnership. And in addition to that, most partnerships do pay out regular quarterly cash distributions. However, because PTPs are not corporations, they do not pay corporate tax, and instead all of the items of income and loss that they have flow through to you as a partner. If the partnership has a profit, that profit flows through to you and you're supposed to report it on your tax return and pay income on it. But if that partnership produces a loss, the loss is not allowed, especially in the case of a publicly traded partnership. That the passive activity losses that restrict PTPs are even more restrictive than they are for other passive activities. And Form 8582 is essentially used to determine if you have a passive activity loss, whether you also have passive activity income that can offset it to figure out how much you're going to be allowed in the current year and how much carries forward to a future year. But with PTPs, they are so restrictive that if you have a loss on a PTP, the only time you are allowed to offset that loss is when you either sell your entire interest in that PTP or you realize income from that same PTP. So the IRS instructions for PTPs are quite specific without having one nice place where they summarize it all and make it easy to understand. So instead you're piecemealing it from a number of different places. Now, one of the things that these partnerships also do is give their distributions. And in the advertising literature, if you were to read the promotional material for a particular PTP and trying to make a decision as an investor whether I should invest in this, the promotional material will say, yes, we're going to give you all these tax-free returns of capital that you're not going to have to pay tax on. And it makes it sound pretty good. Except those tax-free return of capital obviously have to come into play somewhere, and they come into play by reducing your basis. So if you pay $10,000 for shares in a PTP or units per se in a PTP, and that PTP gives you a $5,000 return of capital, it means your cost was just reduced by $5,000. So let's look a little bit at the passive activity loss rules that affect PTPs. I've kind of summarized those in a nutshell for you. Passive activity limits require losses to be carried forward each year until the PTP either realizes a taxable profit or the partner disposes of his or her entire interest in the partnership. So what happens then when you sell the units, and this is where I was scratching my head, because if you sell the units but you don't sell all of the units, are you allowed to claim any of the losses when you are now having to pay tax on the profit from the sale of those units? It made sense that you would be able to do something, but how to go about doing it was a mystery. And that was when I got on the phone and talked to IRS, and we found the answers in a variety of places. So on these pages here, one of the instructions is special instructions for partners for PTPs under section 469K. And it provides that passive activity limitations must be applied separately to items from each PTP. Passive activity losses from a PTP generally may be only used to offset income or gain from passive activities of the same PTP. So you can't use profit from one PTP to offset losses from another PTP. So they all carry separately. That's the first thing that has to go on in the accounting records or the tax return records, is keeping the PTP separate and tracking their income and losses separately. Also, the instructions say not to report passive income gains or losses from a PTP on Form 8582, but other portions of the form do tell you to be tracking information on the form, so it's rather confusing. All in the end, I decided to leave this contradictory information in here in the manual for you and cite the reference, which is the instructions for Form 8582. But ultimately, I wanted to get on to what the IRS auditor told me to do and what I have found in instructions and other documents. So here is an explanation that IRS does provide in the instructions for Form 8582. If you completely dispose of your entire interest in a passive activity or a former passive activity, you may be able to report net income or loss and prior year unallowed losses from the activity. This would refer to any passive activity, not just PTPs. All the net income and losses are reported on the forms and schedules that are normally used. Here's an example. You sell your entire interest in an oil and gas limited partnership that was your only passive activity for a gain of $2,000. You have a current year Schedule E loss of $3,330 and a Schedule E prior year unallowed loss of $1,115. What happens with that is in the year of the disposition, you're going to add the current year loss to the prior year loss, totaling $4,445, and you will enter those in Schedule E in Part 2, Column H, as an allowed passive loss for the year. And then the $2,000 gain from the sale will get reported on Form 8949, Part 1 or Part 2, depending on how long you held that partnership interest. Now here's what the instructions say to do if you have a disposition of less than an entire interest in a PTP. Gains and losses from the disposition of less than an entire interest in an activity are treated as part of the net income or loss from the activity for the current year. If you have an overall loss but did not dispose of your entire interest in the PTP to an unrelated person in a fully taxable transaction, the losses are allowed to the extent of the income, and the excess loss is carried forward to use in a future year when you will have income to offset it. Report as a passive loss on the schedule or form you normally use the portion of the loss that is equal to the income. Report the income as passive income on the form or schedule that you normally use. This is an example that comes straight out of the partner's instructions for Form 1065 Schedule K1, page 5. This is literally where I had to go in all of the documents out there and all of the publications that IRS has to find an example of what to do with the sale of a PTP where you dispose of less than your entire interest. This is where they give this illustration. And it's not in the partnership's instructions for completing Schedule K1 and giving it to the partner. It's in the partner's instructions when they receive K1 and need to know what to do with the numbers that are on it. So it was hard to find that particular thing. I had to go to Google because every time I typed a search for this document on the irs.gov site, it kept bringing me the partnership's instructions for K1 rather than the partner's instructions for K1. And this is in the partner's instructions. Okay, so what it says in this illustration, you have a Schedule E, Form 1040 loss of $12,000, current year losses plus prior year unallowed losses, and a Form 4797 gain of $7,200. Now you may be asking, where does the $7,200 gain come from? Well, the $7,200 gain comes from particular deductions that the partnership has taken that reduce your basis in the partnership. Now oddly, the basis in the partnership for tax purposes hasn't really been reduced per se, at least from the standpoint of the taxpayer, because these losses have never been allowed. They've never had a tax benefit at all. So on the one side, they have these losses that would include depreciation and other items that they're not allowed to claim because they haven't sold the units. And on the other side, those same losses are reducing their basis in the partnership. And so when the partnership is sold, the sale can trigger recaptured depreciation and other ordinary income items that flow through to Form 4797. And in this illustration, that number or that gain amount is $7,200. And the prior year and current year losses that have never been allowed on that partnership total 12. So you can see here that what's going to be allowed to happen is the prior year loss will be allowed to be taken up to the point of the $7,200 figure. So the $7,200 gain is going to be reported on the appropriate line of Form 4797, which is probably in Part 2. On Schedule E, we're going to report on line 28 of Schedule E, page 2, the $7,200 of loss as a passive loss allowed, and we're going to carry forward to 2012 the remaining loss. Now, would you like to see an illustration of an actual K1 with the sale distribution? Because I have one for you. So we have a character here named Magic Debut. He sold units in the publicly traded partnership NSH Transfer Partners LP. He has prior year unallowed losses from NSH in the amount of $6,044, and he received the following K1 and other year-end information from the partnership as shown here. I'm going to zoom in a little so it's easier to read. So the first thing we see here is a loss of $5,502, and if he doesn't sell any units, that loss is not going to be allowed. That loss is only allowed in a year where he sells shares and realizes gain, ordinary income gain from the sale of those shares, or when he entirely disposes of his entire interest in the partnership, or when he realizes income from the partnership in a future year where you might have a positive number in box 1. And in this case, we had a loss in box 1 in 2010, and we have another loss in box 1 in 2011. When we add those losses together, we're getting a pretty big number. The form also shows some interest income and dividend income, and that income is taxable. It's going to flow through to him and get reported on as Form 1040. The interest income is going to go to line 8, and the dividend income will go to line 9. There's also an alternative minimum tax adjustment. There's other income or loss with the code C, and that actually has to do with straddle income. On line 18, we have tax-exempt income and non-deductible expenses, but if you look up the definition of Code C, the $688 is not tax-exempt interest. It, in fact, represents non-deductible expenses. Non-deductible expenses have the effect of reducing Magic's basis in the partnership. Over here on line 19, it shows a distribution. The distribution he took also reduces his basis. Then over here, we show the percentage business or the percentage ownership he has. You can see at the beginning of the year he had 0.001420 units, and at the end of the year, or not units, but percentage ownership, and at the end of the year he had a number that's roughly half that. He sold a bunch, a lot more than a bunch, most of it. We can also see that he's a domestic partner, he's a limited partner, and somewhere in here there's a box that we checked that it's a publicly traded partnership, that we know that that's the case. Then down at the bottom, it's showing some other activity that went on, one of which is his opening capital account. That's his original basis in the partnership. It's showing a decrease for the year of $61.13, and that number comes from the totals on lines 1, 5, 6, and 11, plus line 18 of the Schedule K. So his loss on line 1 is reducing his basis. The income from interest and dividends is increasing his basis, and the unallowed expenses are reducing his basis. So the net adjustment to his basis is $6,113, and that's entered here as a current year decrease. Then we have withdrawals and distributions of $85,009, and the reason that money is coming out is he sold a bunch of his units. So let's take a look at the next page of this document. Now, most of these publicly traded partnerships have pretty advanced accounting and reporting functions in them. You can log onto their websites, access documentation. The documentation is also mailed to you. And this particular cutout that you have here is a direct copy. I've taken information off of a real form issued by a real PTP and transferred it over and changed all the names for the benefit of this classroom. And so you can see that this is showing specific activity of buys and sells for Magic Debut over time. We have buys in 2009 and in 2010, and then when we get to 2011, you can see that there are sales going on. Ultimately, if we total up all of the units he owned at the beginning of the year, he started with 2,700 units, and at the end of the year, he only had 150 left. So he sold 1,500 or 2,550 units. The next side of that is, of course, we would look to be seeing a schedule or a 1099B showing the brokerage account sales, right? And what is the prediction about the 1099B? Do you think it's going to have correct cost basis on it or incorrect cost basis on it? It would be incorrect cost basis. We're going to have to make some adjustments. Now, it will probably, the 1099B, even if the information on it is not reported to the IRS, there's probably going to be a transaction detail report that goes with the 1099B that does tell him what his original acquisition price is, and we need that number. We need to know what the original acquisition price is, but that original acquisition price is no longer his cost basis because partnerships cause the cost basis to change just merely by doing what it is they do, which is flow stuff around. Now, this particular partnership, like most of the publicly traded partnerships, issues this particular statement. It's called a 2011, in this case 2011, sales worksheet. And it also provides all of these instructions. Let's read the fine print together if we can, just for the fun of it, right? Because in real life, you would get this and you'd go, what the heck? You'd either ignore it and throw it out, or you'd actually read the instructions and either understand them or get more confused. What it says is if you sold units in 2011 and the partnership has received information regarding such sales from you or your broker, this sales worksheet may be used to calculate your gain or loss from the disposition of units during this year. First, enter your sales proceeds net of brokerage commissions in column 4. Then enter your original purchase price, including any brokerage commissions, in column 5. We have provided you with the adjustments to basis in column 6, which includes your share of partnership income, deductions, distributions, etc. So all of the confusion of deductions, not allowed expenses, distributions to the partner, those have all been tracked by the publicly traded partnership for the partner. All we need to do is fill out this worksheet to figure the numbers to enter on the return. But it still takes a bit of work to do it. The instructions are right here. This is the worksheet, and some numbers are filled in and some are blank. You can see it's telling us the units that were disposed, the acquisition date of those units, the disposition date of those units, adjustments to basis in those units, and the portion of the gain when we sell those units that will be ordinary gain. But the other amounts, like what we actually sell the units for, the original purchase price that we paid for them, and the amount that will be reportable as a capital gain, we have to figure that out. And where are we going to get that information? Well, we're going to get that information from the brokerage statement, assuming the brokerage statement has the original acquisition cost accurate, has the sales proceeds accurate. We're going to be able to fill in columns 4, 5, and 9, and 7. So let's do that. Oh, and here's the 1099-B, because Magic did get one. Now, for simplicity, I tried as much as possible to make the B match the sales worksheet, but they don't ever really do that because people buy units and sell units in different quantities. They might buy 100, buy another 300, sell 200, right? So nothing's going to match. And for simplicity, I tried to make as much match as possible. But I did, in the end, lump together a sale of a larger quantity than was ever purchased. So there's a little bit of work that has to go on there. But let's just see what happened. We have the date acquired on all of these units, the quantity purchased, and we end up with 2,550 that were purchased. There was actually a total of 2,700 that were purchased, but I'm just only showing you the ones that were sold. And these are the cost in those units, the actual original cost to Magic. These are the sales, and you can see on the sales, the number of sales is more than the number of buys, and that's because the quantity sold on this particular day on 11/15 of 11 is 1,500. And you're going to have to go 100 plus 200 plus 200 plus 1,000 and lump those together to get the cost that corresponds to that 1,500. Over here we say not covered if checked. So all of these units were purchased before 2011. Nothing is required to be reported to IRS, and nothing was reported other than the sales proceeds of $129,835. So the IRS does not have this $96,000 figure, but it does have the $129,835 figure. We never want to file a tax return where we report a number on the tax return smaller than the amount being shown on the 1099-B. That's the first thing IRS does, is it looks to see gross proceeds reported on the tax return are at least a match or greater than the amounts on the 1099-B. They should never be less. Now Magic, if you look at the numbers here, and you take $96,252 and you subtract that from $129,835, has realized a profit of around $33,583. But his profit is actually much larger than that, because his profit has to be adjusted by this ordinary gain figure down here and this adjustment figure here for adjustments to basis. So we fill out the worksheet to figure out what his gain really is. So we go through, and on every single unit disposed of on this worksheet, we find the correlating sales proceeds from the 1099-B, and we enter that in. We also go through and find all of the original purchase information and enter that in. We then add the adjustments to basis or subtract the adjustments to basis from the original purchase price. And then we end up with a total gain that is going to be $62,876. That $62,876 is clearly a lot higher than the starting number of $33,583, right? And then of that $62,876, $25,168 is ordinary gain reportable on line 10 in Part 2 of Form 4797. And the other portion of the gain, $37,708, is going to carry to Schedule D and be entered on Form 1040. But obviously, before we do Schedule D, we have to do 8949 to report each and every one of these sales and the adjustments to basis in them. So if we would enter the sales proceed for each sale, but the purchase price, that's not the number we'll enter. We're actually going to enter a cost of $2,000 less. And so the amount that we're going to be showing as cost is not going to match the original amount we paid. When I get over to Magic's 8949, I'm taking the numbers that I have determined using the worksheet to end up with total cost amounts. And when I do that, I end up with a gain of $37,708 that I report on the form. It's different than the amount shown on the brokerage account, but it's only part of the gain. Part of the gain is going to carry to Schedule D, and the other part of the gain I have to enter on Form 4797. So after I filled out that 8949, I carry my amounts over to the Schedule D, and finally this number of $37,708 is going to carry to the 1040 form. And then on Form 4797, in Part 2, I've prepared a statement just detailing how I've calculated the amount. And the total amount that I got from that worksheet is $25,168. And this is just a kind of a blow-up of all of the different entries I did totaled up to get that number. There's also a rule that says that if the publicly traded partnership, if you have an interest in a publicly traded partnership and part of your gain is ordinary gain, you are supposed to attach an Internal Revenue Code Section Statement 751. And it's supposed to be attached to the return, worded exactly like this. So what you'll see is when you're reading the instructions provided by the PTP, it'll tell you that you need to attach this statement to the return. And you can attach the statement electronically. Your software may already have the statement built in, and if it doesn't, you can hand type the statement into the software and then attach it to the return. But you have to tell the IRS with the statement that you are paying ordinary gain tax on this partnership. The next stage is we have those prior year and current year losses, right? We've just realized ordinary gain of $25,000 on the disposition of those units by reporting it on Form 4797 in Part 2. That triggers an allowance of the current year and prior losses up to $25,000. The current year and prior losses totaled only $11,000, so that $11,546 will be allowed in full. The next stage is to go to the front of the tax return and enter all this information on there. And on line 8A from the K1, we pull over the $36 of interest income. We pull over the $39 of dividend income, including the portion of dividends that is qualified dividends. We enter the amount of capital gain figured on Schedule D through the worksheet provided by the partnership. And we enter the amount of ordinary gain that came from the partnership through Form 4797. We then enter the offsetting loss from the prior and current year losses on that same K1 to arrive at the net income for the year. And obviously for simplicity's purposes, I've given Magic no other income at all. This is the only income he has. Now I did, before I finish off on these publicly traded partnerships, want to show you one more. This is a K1 also issued to Magic, but there's a distinct difference about this K1. If you can study for a minute, who can tell me, without reading the hint, what's unusual about this partnership K1? It's inside an IRA. Thank you. So lots of clients come in with these K1s that they received in the mail, and the reason they received them in the mail is that their IRA has invested into the publicly traded partnership. When you get a K1 like this one, where it says, what type of entity is the partner, and it says IRA, SEP, or KEO, you don't do anything with it on their tax return. This is income occurring inside a tax-deferred account or even a tax-exempt account. It has no bearing on the tax return of the person who owns that account. In this case, Magic Debut, this is his IRA. His IRA invested into this publicly traded partnership. The publicly traded partnership issued him a K-1, and you do absolutely nothing with it on the tax return. So it's one of those things we call a red herring. My preparers come into my office all the time. I got this K-1. My client brought me this K-1. What do I do with it? And I look at it. It's inside an IRA. You do nothing. Do not put it on the tax return. Okay, so that concludes the lecture portion of today's class.
Password number 3 is Breen. B-R-E-E-N. Breen.
It is now time to pause video playback to complete the classwork assignment that is shown on page 84 of your Session 17 student manual. Please review the problem and then push pause on video playback, complete the assignment, and when you're ready, please resume video playback for a review of the answer key. And I now have the answer key for the classwork assignment for Session 17 up on the screen in front of you. This is a very detailed answer key. And I don't think you're going to understand it by listening to me explain it so much. So I am definitely going to not read to you the entire answer key. I'm going to let you print that or read it on your computer screen slowly and absorb it as you can. I think that's the best way for you to really grasp how this particular assignment works. The rule to remember with employee stock options and employee stock purchase plans and restricted stock units is that when an employee receives money from an employer for services, that money is reported on their W-2 as wages. And if that employee receives stock instead of money, the value of that stock gets included in their wages. And there's very specific rules that the employer has to use when calculating that income. So when we're looking at the answer key for Sam Techman, we really need to be remembering those reporting requirements of the employer. And if an employee sells stock for $10 and they paid nothing for the stock because the employer gave it to them, and at the time the employer gave it to them it was worth $8, then we should automatically predict that $8 was included in that employee's wage income, and therefore their basis in the stock is $8 even if they paid nothing for it. And therefore if they sell it for $10, their profit is $2. So we should always be mentally knowing that information and then seeking out proof when we look at tax documents brought to us by a client. So let's look at the tax documents brought to us by Sam Techman. The first one is a substitute 1099-B statement. It's showing us the dates of sales, and it's also saying that these proceeds are from broker barter transactions reported on a 1099-B, and that the basis has been reported to the IRS. So the question is the basis that was reported correct or incorrect? And our job is to do an investigation and figure that out. Well, let's look what we have here. We have a date of acquisition on the one asset. And actually, if you look over here, there is one single asset that was not covered, and that means the basis in this one asset was not reported to the IRS, and that's the chip maker stock sale that occurred on 5/27/11. We have no cost basis information on that is reported on the 1099-B, but the other stock sales do have cost basis reported, and the question is the cost basis reported correct? Now, this item right here, 5/27/11, 508 shares sold with a cost basis of $12,174.22. That particular sale is for the sale of RSUs. And if you look at the advice of sale documents that Sam Techman has received from Chipmaker Inc., we're going to use the information from Chipmaker Inc. to see if we have a correct basis reporting. Because USB is saying that the cost basis is $12,174. Is that the correct number? And the only way for us to know if it's the correct number is to look at the advice of sale documents that Sam Techman has received. These other sales, we also need to look at the advice of sale documents that Sam Techman received. So let's go take a look at them. So this is the advice of sale document that we provided you in the classwork assignment. And it's got a lot of information on it. You can see that we've got RSU, 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 RSU. And there's no way to know through payroll whether these RSUs were properly reported in payroll. We have to assume that they were based on the fact that the Chipmaker Inc. is saying that that happened. But when we go through and add up those numbers, we can see that we have net proceeds here across the bottom, 3132, 5486, 5486. If we look at these net proceeds, that's the amount that we would expect to see on the 1099-B. We then also have the cost basis in these RSUs, and we're just simply going to take the number of units sold, or the number of shares sold, multiply that by the cost basis. And when we do that across the board in blue, because those are the shares that I've identified as having been sold, we end up with total cost basis of $15,541. And when we look at the sales proceeds and add those up, we get $14,105.86. So we have a cost basis of $15,541, and that is higher than the sales proceeds, so we actually end up with a loss. Moving on to advice of sale for the employee stock purchase plan units, these are a little bit more straightforward, I think, than RSUs. Well, that's not true. RSUs are straightforward in that there's no cost basis to worry about other than the value that was included in the employee's wage. So RSUs are simple in that respect, except that RSUs can be partially sold and partially held, and you really have to track the cost basis of units that were held and the cost basis of units that were sold, and year to year be looking for those advice of sale documents issued by the employer, if the employer issued them at all, and then of course any other employee records that the employee has. But for ESPPs, typically, a lot of those ESPPs are sold quick sale. The employee is awarded the stock, they purchase the stock, then they sell the stock the same day or within a few hours or a few days and report that difference as wage income through their employer. And so what we're looking for with Sam Techman is to see that those ESPPs have been grossed up on his W-2. So what we see here by looking at this advice of sale document is that the purchase price of the units is $16,495 when the fair market value is $20,775. So I know that the difference between those two numbers should have been a gross up on Sam's W-2. If we have a purchase price of 428 shares at $16,495, that gives us a cost to Sam of $7,059.86. And the gross up on his W-2 should be for the difference, which is $1,831.84. If the gross up occurred as it should, that means his cost basis is $88.91.70. So then we look to see how much the units actually sold for, and this document is telling us that Sam Techman's net proceeds from the sale are $87.23.91. Is that a match, however, with the 1099-B? And the answer is that it's not a match with the 1099-B, and so the 1099-B is showing an incorrect basis that we're going to have to account for on the 8949 that we file for Sam Techman. Then we have the next advice of sale for his ESPPs, and we show in this calculation that the gross up on his W-2 should be $734.01. And again, we're showing another difference between what is reported on the 1099-B and what actually is showing as net proceeds that he received from the sale. One of the ways to verify that treatment has occurred for an employee in their income is to look for a pay stub that reports that information. And this is an actual copy of an actual pay stub from a real live, real world employer. And I've taken the information from that pay stub and turned it into a problem where you can read what's going on. The first line that I've got highlighted in yellow is the restricted stock units. And the thing with restricted stock units is they are always reported in income when the stock is awarded and not necessarily when the stock is sold. So it's possible to have an award in one year and a sale in another year, and the only way you will ever know cost basis is through the advice of sale and through other records that the employee maintains. But employee stock purchase plans, we should be looking for a gross up on the payroll and for Sam Techman, we exactly see that. From the first sale, I told you that the gain that should be included in his income was $1,831.84, and that the gain from the second sale should be $734.01 included in his wages. And if we add those two calculations up, we get $2,565.85, and it's a perfect match to his pay stub. So I know with certainty what his cost basis in the ESPPs is, and I can prove it by looking at his pay stub. For the RSUs, I can't prove it by looking at the pay stub. The only way I can verify that is going back to the advice of sale documents and relying on those only. So let's take a look at the 8949 for Sam. And we can see that the first 8949, we're checking box A for part 1. That means we're reporting sales for which 1099B is showing cost basis. And we're showing sales of RSUs and sale of ESPPs. And where there is a difference in the cost basis reporting on the 1099B, the true cost basis, we need to describe or explain that there is a difference. And in both cases, those differences can be explained by brokerage fees that have been withheld. And so the gross proceeds are not reflecting that difference in cost basis. So we're describing the difference in cost basis here. So basically, we total cost basis, total sales amount, and the difference in basis reporting. The second 8949, we're showing the sale of 653 RSUs for which no basis has been reported to the IRS. We have cost basis according to the advice of sale of $15,541 and sales price of $14,106 that's showing on the 1099B statement. And the restricted stock unit cost of $15,541 is this number right here. And that's how we figured the cost basis of that particular sale. We've added up the items that were sold. We get a cost basis of $15,541, and that being the total cost basis. And then this is the sale that occurs on the 1099B. There's a second cost basis for RSUs. These are ones for which the basis is shown on the 1099B. They total $12,124, and they occur from these two sales here. So we have 3 sales highlighted in blue. We have 2 sales highlighted in gray. And again in pink, and your job was to basically follow those through and analyze and see how we've treated those on the finished return. And of course, here is the second 8949 again showing the cost and sales proceeds. And those numbers from the two 8949s carry over to the respective lines on part 1 of the Schedule D, where we end up totaling in column H the gain or loss, and in both cases it's a loss. So here we have Sam Techman showing a loss on his Schedule D in the amount of $2,885. So the entire system of employee stock purchase plans very often results in a loss on Schedule D. And as a tax professional, if you are preparing a tax return where your client exercised stock options during the year and they're showing a profit on the tax return, odds are there's a problem somewhere. Although it is technically possible to show a profit, it is usually rare because usually there are brokerage fees that take place at the time of sale, and at the time of sale the total profit is included in the wages. So really you should be looking for an almost even exact match, that sales proceeds and cost are almost exactly the same, and that if there is a difference it's usually creating a loss, and the difference would be caused by sales expenses. And for Sam Techman, his loss is $2,885. So again, if after watching this video you are confused, my instructions to you are to very carefully and slowly analyze this answer key in its entirety, look at each and every line and how I've described it, go back to the original documents and sort them out. And it could take you 3-4 hours of analyzing this to really make sense of it, or it may come to you just like that. The more of it you do, the better you'll get. And let's move on now to the homework assignment. And the Session 17 homework assignment involves preparation of a tax return for Diana Prince. I have to warn you ahead of time that Diana Prince is the most hated of all the assignments I've ever given out in this course. You get universal complaints on it year after year. It's simply because this is a very advanced assignment involving preparation of a lot of different forms, beginning with 1040, also Schedule A, Schedule D, and even though we haven't covered rental income yet in this course, we are asking you to do your best shot at a very simple Schedule E. Diana does not have much in the way of expenses on her property, but while it was vacant, she did incur some expenses. So even though she had no income, she does have expenses. You need to enter those expenses on the schedule, and you can assume that they are allowable. Then you need to complete Form 4797 and a Schedule D worksheet and a Section 1250 gain worksheet for line 19. Let's take a look at the problem. Diana Prince lives at 1919 Paradise Way in Washington, D.C. She sold her rental home to Steve Trevor for $180,000 on April 3rd. The rental house was vacant until the date of sale, and Diana paid the following expenses maintaining the property until it sold, and that included property taxes of $500, mortgage interest of $4,000, and utilities of $500. So you're going to need to do a Schedule E for Diana and enter those three expenses. Diana originally purchased the rental house on January 15, 2010 for $98,000. The land was worth $17,000 at the time of the purchase. She did not live in the house at any time, and she had the following closing costs when she bought it: title charges of $700, other closing costs of $500, and points that she paid on the purchase of $800. We do give you a depreciation schedule on her. Over the years, Diana had made the following improvements to the property, including a new roof, a remodeled kitchen, repairs, a new refrigerator, new carpet, and a new fence. Of course, with repairs, you don't add those to basis. Diana has assigned a portion of the net proceeds from the $180,000 to each of the assets as follows. And so as you're identifying the assets that she is selling, figuring the gain or loss on Form 4797, these are the numbers we want to use for sale price. Diana incurred the following expenses in relation to the sale of the property. Fixing up expenses within 6 months of the sale were $1,400. Real estate commissions paid were $10,900, and closing costs were $1,800. Here is the prior depreciation schedule for Diana. It gives you the base amount for figuring depreciation for the current year, but also it shows you the amount of cost basis that we have and the amount of prior depreciation claimed. But do remember that selling expenses do add to basis, and you're going to need to figure those in. Diana's W-2 is attached. She did not rent out the property during the year. It was left vacant so she could sell it, so she has no income. Her W-2 shows her income is $90,000. So that concludes Session 17 of the Basic Tax course. Have as much fun as you possibly can with Diana Prince's tax return. And in Session 18, we will, of course, review the homework answer key and Diana's finished return. Good luck to you, and bye-bye.